Friday morning. I'm Julie Hyman alongside Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing to know, a big reset in the Treasury market. Yields across the curve are hitting 4% for the first time since November. That means the 2-year, the 10-year, the 30-year, they're all now yielding 4%. It's being driven by expectations the Fed will keep raising rates. And what does it mean for you? Well, the cost of borrowing goes up for everyone, from companies taking out debt to people looking to buy homes. In fact, mortgage rates jumped back over 7% by some measures this week. There are some positives that'll score you better interest rates in your savings accounts. Second thing to know, a solid quarter from chipmaker Broadcom. The company beat on the top and bottom lines and expect to see a major rise in demand for its networking solutions, with its AI investments spurring that demand. Broadcom did say that overall sales growth would slow in the second half of the year, but predicts there will be a soft landing. Its outlook suggests that Broadcom is navigating the inventory glut perhaps better than competitors. Third thing to know, a shift in consumer spending eats into Costco sales. Needs versus wants. Shoppers are spending on necessities but scrimping on discretionary items. That's a change that's been felt across retail. At Costco, that meant higher sales of food and essentials, but a slide in demand for big-ticket items, apparel, jewelry, electronics. All of this translating into a comparable sales gain of 3.5% in February. That's the slowest pace since April 2020. Last quarter, earnings beat estimates, but revenue missed.
The 10-year Treasury yield topped 4% for the first time since November, as investors remain concerned about the Fed's path ahead. Let's bring in IXIC portfolio strategist Garrett Melson here. Garrett, good to see you here with us this morning. First, just as we're trying to get and wrap our heads around all of these majors around 4% or at 4%, what does this signal for the Fed's policy pathway ahead and what the markets are already starting to price in?
Yeah, well, thanks for having me. It certainly has been a very interesting start to the year. You saw a very sharp repricing in the market to that soft landing scenario in January, and that's completely flipped into the no landing scenario that everybody's talking about now. And the basic premise is being that growth is starting to reaccelerate. You see a lot of signs in some of the economic data prints we've seen over the course of February. And the concern is obviously that that's going to lead to stickier inflation and potentially even a reacceleration. I think that's a little bit misguided because, there's a lot of noise in some of this January data prints, but nonetheless, the market narrative has really taken hold of that. And you've certainly seen a repricing of rate hike expectations. So it's not only just that final terminal rates moved higher, but you've seen some of those cuts that were priced in for this year and next, a lot of those getting pushed out or in some cases actually priced out. And so obviously you've seen a pretty sharp repricing on the front of that all the way out the curve as well.
And where do you think, say, the 10-year yield, Garrett, could top out? And then what would the implications then be across asset classes?
So, I think what's really notable about this move in yields is it's very different from what we saw last year. And I think there's a lot of indicators telling you that this is a different environment. What we've looked at is around 4, maybe an overshoot to 4.25 is, potentially in the cards here. So we're looking to add into duration at this point. And I think we're probably closer to the end of that move, especially when you put that together with some of the commentary we've received from Fed officials. But, I think you look at a lot of the performance in the marketplace here, rate volatility hasn't spiked nearly as high as it did with similar moves last year. You're seeing a lot of the defensive names in the markets and the equity market underperforming. You're actually seeing cyclicals outperform. So it's telling you a very different story than what we got used to last year. And I think that's one of the fact that you're seeing a lot of this driven by stronger growth and not necessarily slowing growth and higher inflation like what we saw last year.
Garrett, part of this story earlier this week, we saw Goldman Sachs doesn't think that PCE inflation will fall below 3% this year. Are you in that same camp?
We're a lot more optimistic on the inflation front. Now, that's not to say that we couldn't see it remain sticky around that 3% mark here. But I think when you look through some of the more recent data, there's still a lot of signs of some meaningful disinflation in the pipelines, right? We might not be getting help from the durable goods side of the equation much longer, as you've seen a lot of that inventory adjustment take place. But when you look at the biggest components in terms of that PCE basket, housing is still a very sizable component, not quite as large as it is in CPI. But we know that's going to be slowing down markedly over the course of this year. And I think a lot of the concerns really hinge on the fact that, tight labor markets are going to lead to consistent and persistent upside pressure on wages for a lot of these companies and therefore prices. And I think what you've actually seen is that, that job sprint from January may have been somewhat of an anomaly here. Not to say that it's a weak labor market, but you're seeing signs that, labor markets are normalizing. And so if we were to see that February print come in a little bit softer here, paired with, continued deceleration in wages, I think it's very reasonable to expect that you could continue to see some meaningful progress in disinflation as we move through the course of this year.
So what are the implications then? I mean, you talked about the cyclicals sort of surprisingly outperforming, right? Do you think that continues? Do you chase that kind of performance, or where do you go right now?
Yeah, so we're definitely leaning into that trade. I think the key is, one, you're seeing a reacceleration in growth, and that was very much underappreciated last year. We've been really zeroing in on that for a couple months now, and it's really starting to play out. Now, I think you do need to be careful in terms of what the duration of that reacceleration is and the magnitude of that. But in our view, it certainly is durable. You do have real incomes rising for consumers. You're seeing the labor markets remain strong. You're seeing some signs that a lot of these manufacturing companies are having to ramp back up production here to meet demand. So that's all helpful for the growth story. At the same time that a lot of the drags from last year are flipping to tailwinds, especially as you consider, housing becoming less of a drag, global growth starting to pick up here. So I think what you really do want to be leaning into is that cyclical trade again. And I think that's why you've seen it really holding up here, even with this modest pullback from the early February highs. Now, I think the key, though, is that the risk that you're trying to hedge moving forward, it's not going to be the same hedges that work as last year. And I think that's why you're seeing the defensives underperform. It's not sticky or accelerating inflation with slowing growth. It's stronger growth driving that surge in yields and potentially leading to stickier inflation. And that's a very different backdrop. And I think that's even more evidence to lean into some of those cyclicals that might benefit as well from potentially stickier inflation.
So just quickly then, what should the hedges be now?
Yeah, so what we're leaning into right now is looking at opportunities to add into industrials, pockets of the materials complex. Think of materials and mining, some of the oil service names. I think those are areas where, yes, there's a little bit of a possibility of the consolidation here as they've had strong runs. But I think those are areas that are going to benefit from some of those persistent inflation fears. Think of it as kind of 2022 itis, that persistent fear of reacceleration back in the minds of a lot of investors. But at the same time, those are the same sectors that benefit from a reacceleration in growth. So I think that makes a whole lot more sense in this environment than those classic defensives that have really lagged the market over the course of the first couple months of this year.
All right, copy that. Garrett, thanks so much. Garrett Melson, IXIC portfolio strategist. Appreciate it.
Thank you.
Broadcom beat on earnings in the first quarter, with the chipmaker reiterating that its cloud infrastructure spending does remain strong. Some really interesting commentary sort of across Broadcom, right? With Hock Tan, the CEO, saying there could be a soft landing as companies keep up that spending on networking infrastructure. And the numbers looked decent. If you looked at its fiscal first quarter, $10.33 a share, revenue up 16%. And if you look at the second quarter and what it's predicting, looks like that's ahead of estimates too.
Yeah, the guidance above estimates, as you mentioned there, gave a revenue forecast from Broadcom. $8.7 billion is what they're looking for in the fiscal second quarter. And they got some questions on the call about whether they could kind of foresee further out past the second quarter. Not too much detail that they were willing to offer on that front. However, when you think about some of the other key areas that investors were listening out for on this earnings call, to just see if they say it. Are they going to say it? Yeah, they said it. They said AI for you folks at home. And they said that they're generating AI using large-scale, large language models with billions of parameters, and that they already run thousands of AI engines and tower-enabling large synchronized bus of data, and it goes further into some of the jargon and technical speak, but all in, this is going to be a key category that they did mention on the call, and that they see some potential growth on top of as well. The CEO, Hock Tan, saying that generative AI applications are going to boost the demand for some of their networking chips there.
Yeah, and they need that demand because they're seeing a little bit of demand flagging in the wireless unit. Apple is their biggest customer. They talked about strong demand from, well, they don't name Apple by name. They say that a large North American customer, that they saw strong demand from them last quarter, but that they're going to see the wireless unit overall have a sales decline in the current period compared with the year earlier, so we can sort of read through from that. The company is, by the way, in the process of buying VMware, or trying to buy VMware for $61 billion. And Hock Tan talked on the call as well about being relatively optimistic that that deal is going to get approval. Just quickly wanted to mention another chip maker, and that is Marvell, because those shares are dropping this morning. So again, just sort of illustrating that that we are seeing differences in how these different companies are managing through this inventory glut. And it seems as though the read-through from analysts is that Broadcom's doing a little bit better of a job.
Yeah.
But it also depends on what they're exposed to.
Exactly, and the segments of their business that they're leaning into, or where they find themselves within that cycle of where they've already invested within those segments as well. For Broadcom's case, they're talking about the reflection of continued strength in their infrastructure demand across the end markets, and confident in the growth of the next generation technologies, whether that's AI, whether that's some of the partnerships with their customers. I think at the end of the day, yeah, all of these companies could easily drop an AI mention during any type of conference call over the course of this earnings season, but actually showing customers, yeah, we've been in this space already. We're already being able to monetize on top of that. I think that's what Broadcom was also able to signal through this earnings call too here. Also, let's talk about Costco. Costco is out with its latest report. They beat on earnings but missed on revenue. Shoppers hone in on food and essential purchases and move away from things like apparel and jewelry. Consumers also flocked to its in-house brand, Kirkland. That business saw an increase in sales, which Costco credits to brand loyalty. No mention of membership fee increases on the earnings call, but the CEO said it's coming. We'll do a deeper dive into all of this later on in the show. We've got UBS food retail analyst Michael Lasser, who also, he got a question in on the call last night to the CFO, Richard, who we've spoken with on Yahoo Finance. So we've got much more on that conversation coming up. Also, the tech industry is in transition. Earlier this week, we heard highly anticipated announcements from both Tesla and Salesforce framed around the benefits of a newfound enthusiasm for efficiency that both companies will have moving forward. You can read all about it in today's morning brief written by Miles Udland, and that's up on the Yahoo Finance homepage. But for more, let's take a deeper dive into the battle between efficiency and growth in the tech industry here. And there are a few things to really break down, because he was looking into two companies specifically here, Tesla and Salesforce as well. And for Tesla, as much as we were watching the stock reaction yesterday to their investor day, this is a company that was talking heavily about energy use efficiency and some of the timelines and targets, at least how much they're going to be investing into that. $10 billion, I believe, is what we had heard from the company on the call. But at the end of the day, it's still just about, all right, moving forward from here, what is the actual timeline to achieving this all?
So why don't we read this quote, because it's up on the screen. That's what I'm going to do. John Murphy, by the way, is an analyst at Bank of America, and he said the resounding theme from the investor day was that Tesla can drive growth by increasing efficiency across the organization. And then Mark Benioff said, we've never had an efficiency focus in the company before because we've had 24 incredible years of where we've had to just grow. In other words, we didn't have to worry about efficiency.
Yeah.
Nobody made us worry about efficiency. And guess what? Now, activist investors are circling that company, wanting them to care about efficiency. We've had layoffs there. We've had layoffs really across the tech industry as that has become the buzzword. And not only that, for the most part, the companies that have focused on efficiency have been rewarded following the earnings reports. We saw that with Salesforce. We did not, however, see that from Tesla. And, you know, you wonder what the reasoning behind that is. On the one hand, perhaps it's because, you know, Tesla sort of operates by its own rules in a lot of ways, right? And they're talking about efficiency, but really, I think what investors want to hear from Tesla is about demand. It's about new product, right? Which they did not hear in that meeting.
And efficiency that drives profitability at the end of the day. That's what so much of the activist campaigns, especially swirling around Salesforce, were all about. Prioritization of profits, of margins, and then even in the acquisition strategy that we've seen some of the broader cloud or software companies have in the past, moving away from that as well. And they got what they wanted on that front with Salesforce disbanding, at least for the near term, its M&A team, its board or management team that it had put together to identify these new deals in this acquire to grow type of mindset that so many of the Salesforce peers in the industry have also had, just to weave different kind of portfolio solutions in as well here.
Yeah, so let's talk more about this theme of efficiency and how investors are viewing it right now. Our next guest says there are some surprising areas to watch for investors interested in the combination of growth visibility and low valuations. Ben Laidler's with us, eToro Global Market Strategist. Ben, good to be with you. So we were just talking about efficiency and how really the narrative and the priority for so many companies, particularly within large tech and what had been growth, have switched to that narrative. And they seem to be rewarded for that. Is that really what investors are focusing on right now and what they want to hear and what they're really making investment decisions based on?
Yes, I think so. I think the number one question for investors right now is earnings visibility and resilience of earnings, and anything that feeds into that. I mean, the narrative so far, the reason that we are where we are and markets haven't done worse is earnings have really been hanging in there so far. The question is just how much longer can that continue? If the Fed keeps raising interest rates, keeps them high, and the economy ultimately slows, which it will. So I think they're right to be focused on the earnings visibility. I would just maybe add to that, though, valuations are still important, and maybe more important right now with bond yields rising.
Ben, as we were mentioning a moment ago on this theme of efficiency, it really is efficiency that drives profitability that a lot of the activist campaigns seem to have been prodding for. And, not even just with Salesforce and even with the Tesla conversations about efficiency. We'd heard this kind of within Disney as well here. So at the end of the day, which companies are best positioned to kind of flip a switch to say, yeah, we can be more efficient, and that can immediately dovetail or translate into profits?
So I think tech is obviously the focus because you have this massive expansion over the last few years, and that is now unwinding a bit. So they clearly have the fat to cut. But I think more broadly, if you look at U.S. companies versus the rest of the world, these margins are still above average. These are not companies that are inefficiently run. If anything, I would argue they've adapted sort of very well to this environment. So I think tech in some ways is the outlier because they do have that cost lever that they can pull pretty aggressively. I'm not sure that lever is going to be as strong in other sectors.
And so does it matter in other sectors, though, in the same way, Ben?
I think there are other drivers in different sectors. So, I mean, we quite like the sort of defensives, the cash flow generative stocks, the things that did well last year and haven't done quite so well this year. I think they're going to come back in favor because we need to keep buying them. That gives them some top-line stability, which maybe other more cyclical sectors don't have. It also gives them pricing power, which allows them to offset the cost increases, which are still coming through, and keep those margins high.
Okay, and so in keeping margins high, it seems like everybody is on the defense to keep their margins high right now. Is there a best protection strategy that investors out there should be looking for in order to kind of best position their own portfolio around companies who are able to best protect their margins?
Yeah, so I think the problem right now is higher bond yields are putting a cap on valuations. So anything that's done with high valuations and particularly those sectors, those disruptive tech sectors, which have done very well over the last few months. I think that's where there's going to be a bit of pressure. And I think there's going to be a refocusing on where is that growth visibility? Who has the margins? Who has who's selling those products that we need to sort of keep buying? That's why I think there's going to be a bit of rotation here. If you like, a sort of deja vu trade back into this sort of 2022 winners, the sort of staples, the sort of high dividend yield. But also some surprising places. I mean, we've been talking about airlines recently, which has traditionally been a terrible place to invest. But right now, they're seeing both sort of long demand recovery and they're seeing pricing power because they've managed capacity pretty well.
Ben, it seems like we've had sort of a resetting of the narrative over the last few weeks. We've certainly had a resetting of bond yields, as we were just talking about. Now everything's at around 4%. How long do you think that regime can last? And what is the next catalyst you're looking to potentially reset the market again or change sentiment again?
So we're all data dependent, for better or for worse, from me all the way through to the Fed. So we're all following the data. You're right, we have had a bit of a reset, right? But I still think the narrative is still one of lower inflation, near peaked interest rates. We have had a bit of a reality check. We pushed that back, a month or two, but that still is the narrative. And I still think, the economy is going to gradually slow. Inflation pressures are going to gradually slow. It's no surprise that services and wages is the bit that's sort of lagging that. I still think that's the narrative. That still keeps us invested in stocks. Why we think October was the low. I just think with bond yields where they are, now is the moment for just, a little bit more caution, especially if you've been lucky enough to, ride those disruptive tech winners over the last few months.
Ben, given the airline kind of appetite that you may have right now, as you were laying it out just a moment ago, what would you look to within the data to say that there is a turning over of that demand, even though they are in their own recoveries right now, and there is the pent-up demand for travelers that continues to be holding up strong right now?
Yeah, I think the positive surprise throughout all of this has been earnings, and what's driven those earnings has been the U.S. consumer. Partly on pent-up savings, but also partly, and we don't talk enough about this, we've had 7 down months of inflation. That is slowly restoring, I think, consumer purchasing power. And I think that's probably going to be the biggest driver. If we avoid recession, that will be it. Consumers getting some of their purchasing power back. And as part of that, they're choosing what to spend the money on, and they're prioritizing things like travel over other things, particularly things like tech hardware, which we all overconsumed on in the pandemic, which is on the flip side why you're seeing some of the weakness you're seeing in tech.
Yeah, most definitely. And the desire for people to get out and about and spend their money on doing things instead of buying things. Ben Laidler, good to talk to you. eToro Global Market Strategist. Have a great weekend, Ben. Coming up, week outlook. Dell trading to the downside in pre-market as the PC giant stokes fears that demand for computers continues to go down. We'll bring you that and all of the other movers next.
Warren Buffett's annual shareholder letter is out. Here are 3 top takeaways from the Yahoo Finance team. First up, a call to action to all humans: start saving money. Buffett says this: "It is those dedicated savers that are forefront in my mind as I write this letter." He adds, "Charlie and I are not stock pickers, we are business pickers, telling people to save money." And maybe they're listening. The U.S. savings rate is now at a 1-year high at about 4.7%. I think Buffett wants to see it even higher. Takeaway number 2, investing school is in no session. Again, no surprise here in the Warren Buffett annual shareholder letter. Buffett noting this, saying, quote, "The lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders." And yes, it helps to start early and live into your 90s as well. Warren Buffett, 92 years old. His longtime partner, Charlie Munger, 99 years old. Warren Buffett saying, if you want to be a successful investor, invest for the long term. No surprise, that's typical Warren Buffett being Warren Buffett. Takeaway number 3 here, a message or messages to all politicians here. Warren Buffett taking some jabs at folks in DC, noting this: Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Interesting take there from Buffett. Buffett also says, really tries to, I think, champion stock repurchases, saying repurchases, those that tell people that repurchases are harmful to shareholders or to the country are particularly beneficial to CEOs. You're listening to either an economic illiterate or a silver-tongued demagogue. So Warren Buffett taking some swings at politicians. What we did not hear in this letter: no succession plan. Warren Buffett and Charlie Munger will be at that May 5th to May 6th annual shareholder meeting in Omaha. Brian Salzi out.
Let's look at some movers now. Dell is one of them. It's down almost 3%, out with a beat on the top and bottom line in its latest quarter, but revenue is down 11%. Computer maker also providing a disappointing outlook for investors, so that's why the shares are down. Revenue is going to be down about 19%. Sequentially, so quarter over quarter in the fiscal first quarter, which ends in May. That's a forecast that the company came out with on its conference call. And infrastructure will be down in the mid-20s%, which is kind of ironic because weren't we just talking about demand for infrastructure when we talked about Broadcom?
Exactly. And the Infrastructure Solutions Group was up during the quarter, but it's the forecast for that Infrastructure Solutions Group. So some softness there. It was up 7% in this most recent quarter here, and even above the street consensus there. The PC business, though, this did see some weakness. Revenue of $13.4 billion. That was down 23%. Still came in above expectations, but my goodness, that was lower double-digit percentages there. And then commercial PC revenue, that was off 17%. And here's where it really gets hairy. Consumer was down 40%.
Ooh, well, the company is also saying for the full year, revenue could fall by 12 to 18%, and the CFO saying there's a wide range of outcomes, and that's another way of saying it's difficult to predict. Yeah. I was struck by some comments that a friend of the show, Jim Suva of Citi, some comments that he wrote in reaction to this. He said Dell tends to be kind of conservative, and so that you have to view the guidance through this lens. He said this is typical Dell conservatism, and just like they just beat last quarter's numbers, that they'll likely to continue to do so. I mean, companies do tend to beat, by and large, more than they don't.
Yeah.
So I guess we can just take all this stuff with a grain of salt.
Right, you can ask yourself who's sandbagging all day, but at the end of the day, we still kind of glean the insights off of what they announce. Right. However, that era could be changing of conservatism in terms of how they are putting the numbers out there. You got to change over in the C-suite. The chief financial officer, Tom Sweet, going to be retiring after 26 years at the company. So we will see if under the new leadership of Yvonne McGill, who's been the corporate controller, who's been with the company as well for about 25 years, for a century there, my goodness. So
people really settle in there, don't they?
Right? They just come, park, and just, hey, you guys got all the meals here, right?
Why
Great.
not?
Why not? So yeah, we'll see if that changes at all, but maybe it won't, given that they both overlap there for such a long period of time.
Well, we're setting up for the opening bell here this morning, and I'm just taking a look at the numbers for the week on the S&P 500. It looks like we're setting up for a Very small gain of about 1/4%,
Hey, big
right?
money.
And considering that recently we have been seeing some weakness, the past 3 weeks have been down weeks for the S&P 500. So this would break that losing streak, although in pretty mild fashion, right, with just about 1/4% increase. So more of us, like we had sort of that big reset, that big digestion of rate reset expectations. Now the 10-year gets to 4% and across the yield curve gets to 4%. And now maybe there's a little drift. We'll see what ends up happening with that. There's the opening bell. It looks like Time Inc. is ringing the old Time Inc., now Time Magazine, I guess, is ringing the opening bell there this morning as we are looking at a little bit of positivity to end the week. I mean, as I said, if we're just looking at 1/4% gain for the week on the S&P, that can be wiped out relatively easily, but it does look like that we are pointing in a positive direction in today's session. So we'll see if we keep it there that way for the remainder of the day. Brad, as we look at the Interactive, what kind of action are we seeing to get things up? Oh, look, we have the weekly chart.
I got the full week pulled up for you.
it.
You know, you set them up and we knock them down here. All right, S&P 500 up fractionally over the course of the first 38 seconds of the trading session here today. But over the past 5 days, holding on to a net gain of about 0.7%. Tech-heavy Nasdaq, that's higher over the past 5 days by about 1.1%. We'll round that off to higher this morning by about 0.5%. And additionally, the Dow Jones Industrial Average, that's up by 1/4% out of the gate this morning. Let's take a look at some of that sector activity as we're tracking. It's just been a huge week, Julie. There's been so much going on in terms of the investor days from Tesla. You got a plethora of earnings that have come out, both from retail as well as some of the software companies as well. And so all that considered here, let's take a 5-day look at just how everything has done over that course of time. This is a 5-day look for you. We're just taking a look at the intraday. We'll get back to that. But overall, you've got about 4 laggards on the week. Utilities pulling up the caboose on the week, but leading the gains on the week up by about 3.2% on the sector performance is materials here. So that is higher out of the gate this morning as well. And now let's put this back on an intraday view here. You've got about 9 out of 11 S&P 500 sectors in positive territory, led this morning by communication services. That's up by 0.9%. Energy is pulling up the rear. That's down by about 1% right now. And just brief look at the mega cap tech stocks. On the Nasdaq, there we go. All right, on the river, it comes up. Apple, that's higher by about 1.2%. Amazon, 0.9% to move higher there. Tesla, perhaps rebounding just a little bit here on the day. It's up by about 1.6%. And then you've got Microsoft, Google with some fractional gains. Meta Platforms up 2% right now.
Yeah, Apple, we're going to talk about later. Morgan Stanley call on the company. We're going to get to that. But let's get to this one now. Zscaler trending lower, off by about 12% despite beating analyst estimates. The company saw additional delays in large deals in the second quarter as it provides lackluster billings outlook for full year fiscal 2023. Full disclosure, I have a confession to make, Brad.
Yeah.
Whenever we talk about these sort of like large scale enterprise software companies, I'm like, what does this company do? I don't quite get it. So I looked it up for Zscaler. This is what it does. It accelerates digital transformation so that customers can be more agile, efficient, resilient, and secure. Does that help you? Does that help you decide? Then they go on a little bit more. The Zscaler Zero Trust Exchange protects thousands of customers from cyber attacks and data loss. Okay, I get that. By securely connecting users' devices and applications in any location. So basically, an enterprise security company is how now I have wrapped my head around this particular one.
Yes, I think that is the best way to position it, or at least the most clear for conciseness, because once you get into all of the different ways that they operate and how the billings come through, and then it just gets murky all over again. So I think for some of the results that we're seeing in the share price reaction here on the day, investors not impressed, and perhaps they want a new definition of how Zscaler is actually able to communicate to the street what they do. But here today, they're down by about 12%. And one thing that really jumped out to me as well here within this, we had seen their net income loss of about $57.5 million. Now that is compared to $100 million, a little bit more than that in the second quarter of fiscal 2022, lapping that kind of year-over-year comp. So improvement there, but at the same time, investors clearly wanting to see more from Zscaler in improvement. They did exceed their own revenue and profitability guidance in Q2.
Yeah. Well, it looks like investors want a little bit more in billings, which is sort of more forward-looking. That they raised their guidance for billings for the full year, but they raised it by a small amount, and
Right.
it seems like investors wanted a little bit more on that front. So that might be what's going on here and what's responsible for the disappointment.
This has been the week of the kind of cloud or software company jargon, where you've got them talking about calculated billings, or they're talking about remaining performance obligations. Perhaps that's going to be our next kind of 5 keywords that we should break down for
I
folks.
think we need to do a
that.
lot of jargon translation.
Yeah, we got that done. All right, well, a company that needs no translation at all, Victoria's Secret.
True.
They beat out with an earnings beat. However, the retailer forecasting trouble ahead, with the first quarter 2023 net sales expected to decrease in the mid-single digit range. There, you're taking a look at some of the actuals versus the estimates. It was in line on the revenue front, but beat there on EPS here. And in the very much kind of WYSIWYG, or what you see is what you get type of company here, that's just what you got here with Victoria's Secret. One of the things that they did note, looking back on 2022, their first full year as an independent, publicly traded company, we should remind folks, this was a company that used to be tied in with one that dealt with soaps. So at the end of the day, this is a big year to be lapping for themselves.
Yeah, I guess it is a big one for I mean, when you look at those comp sales numbers, they were just not good. I mean, there's no other way to slice it, right?
Yeah.
When you see comps that are down by 6%, store-only comp sales down by 7%, and the first quarter forecast is also just really lousy. There's no other way to put it. Adjusted earnings per share in the fiscal first quarter going to be 30 to 60 cents. Analysts were looking for 84 cents. So, there's still some supporters, I think, of this company in the analyst community who have looked at the company sort of getting itself in shape, closing a lot of stores, improving the footprint, but it doesn't feel like it's quite there yet.
And improving inventory too. And if there is one thing that we might be able to extrapolate, or at least a common denominator that we can draw through a couple of the retail or clothing manufacturers over the course of this earnings period, and you heard this talked about on Costco's call last night too, was how inventory is improving right now, or at least their management of it, and understanding, even coming off of the holiday season period, where consumers were taking inventory at select prices, or where they would not. In Walmart's case, try to chase price for promotions and whatnot. And so within some of those more discretionary categories, that inventory acknowledgement is going to be key to watch as we get more into some of the sneaker companies too in the footwear category.
Meanwhile, what you see is what you get reminded me of a song that I'm going to play during the break.
Ooh, yes.
That's a teaser for you, not for them.
Oh my goodness! All right, they told me to tease. I was going to sing it for our folks anyway.
Oh, you can
coming
do
up, yeah, sometimes. Fat Finger, Bitcoin's $1,200 fall in just 30 minutes is likely related to fears over crypto-focused bank Silvergate, or maybe it was just a big old trade. Jared Blickery going to weigh in and decode it for us next. Welcome back to Yahoo Finance Live. A dramatic fall for Bitcoin as concerns mount over the contagion caused by crypto-focused lender Silvergate. Let's get on over to the Wi-Fi Interactive where Yahoo Finance is. Jared Blickery is standing by. Jared.
Yeah, Silvergate earnings came out a couple days ago. Well, actually, they were supposed to, and that's a problem. They had to file a notice that they were going to be late with the SEC. A bunch of analysts have weighed in, and I'll get to that in a second, but I just want to show you the reaction in Bitcoin. This is a pretty big deal. Silvergate, one of the huge bankers to the crypto industry. This is a year-to-date chart of Bitcoin, and you can see this is the biggest down candle we've seen in a long time. And just on an intraday basis, Bitcoin never sleeps. This happened while I was sleeping. Guess what? Pretty steep drop here from the 23.5s back down to about 22.3. So pretty big handle that we're looking at right there. Now, on a longer term basis, I think this is significant because 25,000, that is the high that we were looking at before, and that is a high right there for 2023. This was a level that was pretty much in play for a long time, and the inability to get above it is a little bit concerning. The next stop would be 30,000, just because round numbers have been in play here, but that's actually where a lot of price action coincides as well, something around there. So I guess the bottom line is we're going to have to see what the fallout for this is, but we already have some analyst reaction, and I think this kind of encapsulates. This is from Canaccord Genuity. First of all, they're downgrading Silvergate to hold from buy, price target down to $9 from $25, but they're quoting, here's a quote from them, given its success, and this is Silvergate, in becoming a key component of financial services infrastructure to the digital assets industry, the bank to some degree has become a lightning rod victim of circumstances, given industry news flow over the last few months. One more quote, we are not aware of any chartered bank in U.S. history, going back a long way, that survived such a deposit drawdown as did Silvergate post the FTX collapse late last year. That I would assume that includes the Great Depression, where we saw a number of bank failures. So Silvergate is still a going concern, but there are questions about its survival, and we've seen this before. Let's take a look at a Bitcoin chart and just plot what's happened over the last year in response to the FTX fallout. Of course, we had Celsius first and some other failures basically in the middle of last year, but these were the losses we were looking at. Now, when you have leverage built up in a system such as crypto, it can take a long time to deflate that. And one of the key things that I've been looking at is Binance and Binance token. And that is something that we've still seen kind of hover around $1, and that's what it's supposed to do. So as long as Binance token, I would say, isn't deviating from its benchmark too much, probably have a decent chance here of avoiding another catastrophe. But let me go back to a Bitcoin chart. Guess what? If we go to see the lows that we had from several years ago, we could go all the way back down to 13,000, and that is if we have another huge failure here, and that would be the big one, Binance. So I don't know what's coming here, but that would be my warning. Before I go, I just want to take a look at crypto stocks, how they're doing today. We can see kind of a mixed board here, and let's just take a look at what's happened over the week. A lot more red than green. Silvergate down 61%. Looks like Marathon is down 7.5%. Coinbase, let's see if that's there.
Upper left.
Yeah,
wow,
upper left.
I'm surprised.
Coinbase up 6%. Was that it? Did they announce earnings this week, or was that last week?
They also made the move not to engage with any of the transfers from Silvergate.
Yeah, so no, well, I think
And they're going to be doing maintenance this weekend, aren't they? I think they're shutting down for maintenance.
Coinbase?
Sounded right, yes.
I'll take your word for that. I know that Coinbase has shut off access to Silvergate along with just about everybody else. So that's what's been happening there. But here's the Coinbase chart. You can see not much of a liftoff despite that 7% gain that we were looking at. Not much of a liftoff off of those lows just yet, guys.
Thanks. Appreciate it, Jared. I was trying to look up more
Yes.
details on that Coinbase shutdown. Did you get it?
It is correct, yes. An 8 hours to complete is the technical systems upgrade that's starting Saturday, March 4th on or
Coinbase.
around 8 a.m.
Coinbase sleeps. Bitcoin doesn't sleep.
Yes, it is very, very
8-hour nap. That's what we're talking. That's all they need.
Just a nap. All right, thanks. Coming up, Costco CFO says the business will, quote, do what's right to drive sales as they look to high-velocity items. What does that mean? What are high-velocity items? We're going to talk TV's rotisserie chicken. Hot dogs, maybe? All things retail next.
if you go do a little homework on what the cost of processing and selling a rotisserie chicken, our $4.99 price is which we maintain is an investment in low prices to drive membership, to drive sales in a big way. So there's some things that we do, notwithstanding huge inflation over, and even though some of the costs have come down a little bit, relatively speaking, we want those wow items in there as well.
Well, despite low prices on store items such as the $4.99 rotisserie chicken, Costco reported mixed results late yesterday. Consumers seeking value trimmed their discretionary spending. Is it doom and gloom on the consumer front? Are those dollars getting spent elsewhere? Let's get to UBS U.S. hardline, broadline, and food retail analyst Michael Lasser for more on Costco. Thanks so much for being here, Michael. So to the point of where those dollars are going, are some of them going to a Walmart, for example? Is Costco seen as, maybe because of the membership, maybe because of those other items, as a higher cost option, and we're seeing some migration?
I don't think that's the story here. I don't think the consumers trading down or trading around to other channels. Costco offers a very good deal for the consumer. You pay to shop there, and the reason why you pay to shop there is because you find prices that are as good or better than anywhere else. I think what's happening is the consumer's retrenching. We're hearing and seeing that in a lot of different areas, whether it's home improvement, home furnishings, consumer electronics. For instance, Best Buy noted yesterday that its sales quarter to date in February were down 10%. It's just a reflection that the consumer is getting a little uneasier, and the consumer had purchased a lot of these big ticket discretionary items over the last few years and is shifting to spend to other categories like services such as traveling, going out to eat, and going to concerts. So I think that's the story more than this is a Costco specific issue.
Michael, you got to ask a question on the call last night. I'm wondering if you were satisfied with the answer that you got from Costco management. I mean, Richard, my goodness, he seemed unfazed. He was talking about how the company's moved through past uncertainty. So what's going to be different about this one? Were you satisfied with what you heard?
Brad, I thought that the message from Costco was they can manage through all sorts of different economic environments. They tend to do well during good times. The consumer has more money to spend, and they spend it at Costco. They tend to do well during tougher economic times because the consumer needs to rely on Costco more to stretch their budgets. That was the message. They also noted that if we do enter a more severe downturn, they're going to be there for the consumer by investing more in prices. And that's going to probably weigh on the P&L for the short run, but it's the right thing to do. This is a model that is heavily driven by the top line sales growth. And at the heart of what drives the top line is the member. And so as long as they're holding on to the member, this business should work very well. And they said yesterday that in the US, 92% of their members are renewing. They're really voting, and they're saying, hey, Costco's important to me. You can't find many businesses where 92% of the customers say, this is so good that I'm going to continue to pay to go there.
I wish I knew what that number was at, say, Amazon Prime, for example, Michael, but I don't. A two-part question then for you. Is that 92% in line with historical averages for Costco, part one? And part two, are they going to be raising the fee for membership anytime soon?
So that number is not in line with historical trends. It's actually better. So it shows how committed this customer is to this model. Second question is, when are they going to raise the fee? I suspect that they'll announce it later this spring and implement it early this summer. What they find is that as they get the profit infusion from this fee, because it really is pure profit, that they take a portion of that and reinvest it back in lower prices. And that helps to drive the model. That helps to differentiate Costco versus other retailers out there. So I think they look at it as this is an opportune time to charge a little bit more for the members because we're delivering so much value to them.
Michael, one thing that we heard about on the call as well was the new head of digital and what that timeline looks for. Perhaps this digital transformation that is yet to really commence or take place in a kind of critical mass capacity over at Costco. what do you believe they need to get right in order not to lose out on the consumer that is more digitally focused?
So the competitive frontiers in retail right now are twofold. One is delivery, and Costco's made some extreme investments in delivery over the last few years. They basically bought the logistics infrastructure from Sears to be able to deliver big and bulky items, have trucks and distribution centers to fulfill those large orders. And that's really helped them advance their e-commerce business a lot over the last few years. The other competitive frontier is data. That is really the oil that makes this business, along with many other businesses, to grow. And there is no other retailer who has more information around who their customer is, what their customer is buying than Costco, because you have to have a membership to shop there. So increasingly over time, Costco is going to be able to leverage that data to tailor their assortments, offer very targeted promotions, run their business better. And that's an untapped opportunity for Costco. Costco tends to move pretty slowly, but when it moves significantly. And we expect that to happen over time.
And then just lastly, while we have you here, we heard about Kirkland not being a trade down, but of course they talked about it as a trade equal or even a trade up in some cases. I'm just surprised we haven't seen some type of, artist collab with Kirkland at this point, given the fact that it is such a household subsidiary for anybody who does or doesn't have a Costco membership. So within that, is Costco winning kind of at this trade down battle right now that we're seeing among some of the wholesale retailers?
I wouldn't put it past Costco to have some sort of collab like that in the future. So that would be an interesting opportunity for them. Kirkland Signature is a key differentiator for this business. The consumer looks at Kirkland as a really high quality offering at a very value conscious price. So I don't think the consumer looks at it as saying, hey, I'm buying a cheaper product or a lower quality product. I think the consumer looks at Kirkland as a very important part of their weekly regimen. I would expect that will continue. And I think the consumer looks overall at Costco as a key place to help stretch their budgets at a time where their budgets are under pressure. So I don't think Kirkland is, Kirkland is a key part of that.
All right, waiting for that collab to drop. Brad, what's your dream Kirkland collab?
Kirkland collab. I would love to see Kirkland collab perhaps with Mac McClung, who just won the NBA All-Star dunk contest. Why not? Why not? The people need to see it. That would be cool, right?
Okay. I hope the Costco execs are listening to us right now, Michael. Thank you so much.
Okay.
UBS U.S. Hardline, Broadline, and Food Retail Analyst Michael Lasser. Have a great weekend, Michael. Thank you. Time for a trending ticker alert. We're looking at ChargePoint. EV charging provider ChargePoint is losing energy with investors after reporting a revenue miss and disappointing guidance. The company betting on rising EV adoption to help arrest its cash burn and reset the conversation. It's still facing those supply and shipment challenges in its rollout, clouding its path to profitability. JP Morgan, one of the first to react, reducing its price target for the stock to $15 from $16, shares down 4.5%.
Coming up, here's some of the big interviews that we're just excited about for this hour here. Another company betting on nationwide EV charging that accepts any vehicle. We chat with Michael Farkas, who is the Blink Charging CEO, about what's ahead for the industry.
Vertical consolidation continues in the medical industry with big names like CVS and Amazon buying up health startups. The future of health with Sachin Jain, Scan Health CEO.
And C3AI seeing a boost on earnings with analysts zooming in on the company's enterprise AI. We're going to chat with Tom Siebel, who is the founder and CEO. Stick around for all of that and much more on Yahoo Finance.
Welcome back to Yahoo Finance. I'm Julie Hyman with Brad Smith, and we are awaiting breaking economic data in just a moment on the services industries in the U.S. We just got a little while ago from S&P Global its final read of services in the month of February. It came in at 50.6. That's in line with its earlier read. Remember, I always like to remind you, 50 dividing line between contraction and expansion. So services, as we have talked about, has been growing as people pivot away from buying stuff to doing stuff, right? Going out, traveling, et cetera. Now we're getting the ISM number. It's coming in at 55.1. So two different reads basically on the same thing from two different sources. This is the Institute for Supply Management. The services index again at 55.1. That is a tenth of a point lower than the month of January, but it's better than expectations. Again here, just like what we got with the manufacturing index the other day, the prices paid component is hot, 65.6 in February. That is down from 67.8 in January, but still 65.6 is still quite high. So for services, and listen, we can all anecdotally sort of confirm this, right? That services are still going higher in price, whether you're talking about travel, whether you're talking about eating out, et cetera. The employment component of this index at 54, and new orders also relatively high here at 62.6. So, Brad, when all is said and done here, this is yet another reading that shows relative strength in the U.S. economy and also still relative inflation.
Yeah, and taking a look at the market reaction here this morning, too, you do see a little bit of just before the start of that 10 a.m. hour, it's moved lower off of, though, some of the intraday highs that we had seen early in today's trading activity on the Dow Jones Industrial Average, still holding on to gains of about 0.25% in the green. The Nasdaq Composite, you're seeing that also in positive territory, up triple digits on a point basis, percentage basis, it's up by about 1%. We'll round that off, too. And the S&P 500, you're seeing that up by about 0.7% right now, still holding on to those gains. And additionally, checking in on the major sectors here, the S&P 500 11, taking a look at those sectors, and XLB is leading the pack, at least on that previous time scale that was loaded up on the screen. XLRE, though, here on the day, on this Friday, it's higher by about 1.25%. But you've got XLP, yeah, indeed, consumer staples not looking so hot, down by about 0.7% here this morning, and we'll continue to watch that as we move on throughout the rest of the day. Overall, though, you've got more gainers than laggards here, and we'll continue to keep a close eye on that. Taking a look at some of the Dow components as well. Apple is really leading the charge today. You're seeing that higher by about 2.5%. We've got much more on that this hour as well. And taking a look at the Nasdaq, you've also got a pretty mixed picture here. We'll kind of put this on a broader heat map view. It looks like more gainers than laggards, just a rough look at things here on the day. But since we mentioned Apple.
Yeah, let's talk about that call that you were just mentioning, right? And it's coming to us from Morgan Stanley, which is picking out 5 catalysts here, rising subscription offerings, one of them that could drive the tech giant's next big bull case. Again, this take from Morgan Stanley analyst Eric Woodring. And he also citing re-accelerating iPhone and services growth here in this call. Overweight call, $180 price target. And I'm looking through here what he calls the 5 underappreciated catalysts. One of them, he says, pent-up iPhone demand should fuel above consensus shipment re-acceleration in the fiscal year. So interesting there, because there has been, you know, not doom and gloom, but certainly a little bit of caution around demand for this latest cycle of the iPhones.
Right, and just people trying to figure out, okay, not just the pricing mechanisms or the strategy that Apple is going to roll out and what the future iterations of the technology will hold for the device that is practically at your right or left side on your hip at pretty much any time of the day, but also even in the different regions where Apple is going to be trying to make sure that they're staying in the hands and the minds of consumers. Think about particularly China and the number of consumers that could potentially be saying, you know what, with some of the stimulus that's getting rolled out in the reinvigoration of that economy post zero COVID policy, what that could actually translate into some gains for Apple, potentially on the product front. But then for us other consumers who I just need to get my screen fixed at the end of the day, I think that's where you have more of a propensity, or have seen more of the users hold on to that device for a little bit longer, at least on this scale that we're in the midst of right now.
Yeah, and so some of the other things that Eric Woodring is talking about here: record installed base growth, a re-acceleration in App Store, easing currency pressures, pricing increases across services will return services to double-digit revenue growth in fiscal 23 and 24. So I guess that's catalyst number 2, is re-acceleration in services to double-digit revenue growth. So interesting here when we're looking at the case here for what Apple could do.
Yeah, indeed. And Apple more broadly here on the broader Wall Street equation here: 36 buys, 8 holds, only 2 sells among some of the analysts that are tracked by Bloomberg here. So still a lot of positivity on the street for AAPL.
Yes, indeed. And that's why the shares are up today. All right, Amazon's acquisition of One Medical has pulled healthcare M&A into the spotlight. For a deeper dive, let's get to Yahoo Finance's Angelica Mlani, who's here with the guest.
Thanks, Julie. Big retailers and tech giants continue to make their way into healthcare with the potential for industry transformation, but not without downside risks. To lay out the path forward on the push into healthcare delivery, we have Dr. Sachin Jain, Scan Group and Scan Health Plan Chief Executive Officer. Sachin, thank you so much for joining us today. I know that this is something that you have really opined on. You recently wrote up a piece about it as well. It seems like there's a lot of interest in this retail push into healthcare, but I know that you have sort of a cautionary tale. Tell us about it.
Thanks so much for having me, Anjali. Look, these are potentially industry transforming deals. I think people have long hoped that retail plus healthcare could equal a better experience for patients. But the cautionary tale is really about the very different cultures of retail and clinical service entities. And I think these deals could end up being highly transformative for healthcare, or they could go down as potentially the worst deals in the history of the healthcare industry. Both Oak Street and One Medical are remarkable companies. I think hatched as independent companies, venture-backed, grew rapidly over the last decade. Remarkable founders, huge attention to clinical culture, and they're now being merged into large publicly traded companies that do other things. And I think the opportunity is really to connect the dots, to take the Amazon Prime offering and connect it to the clinical care offerings in One Medical. For CVS to merge some of its insurance offerings through its Aetna franchise with some of the retail capabilities through CVS, with some of the clinical capabilities of Oak Street. I've just been around the block enough to know that oftentimes, publicly traded entities don't necessarily understand clinical culture. They're making decisions sometimes for the short term. And when you are making decisions to hit a quarterly earnings target, you aren't necessarily doing the things that you need to do to improve people's health over the long term. And so these deals, again, like I said, could be the very best thing that happens for U.S. healthcare, or potentially the very worst.
It's interesting to me that we're seeing this push, considering what I think is the complete opposite happening, say, in the pharma sector, right? You see companies divesting their consumer brands, trying to become leaner machines. So it almost goes to this healthcare industry at large isn't really on track. No one's on the same page, and there's so many little things going on at the same time. I just wonder, should consumers really be paying attention to these moves? Because I almost feel like people don't even know that CVS is more than just a drugstore company.
Yeah, I think, I think consumers are going to be hit over the head with it over the next couple of years, because they're going to see it every time they walk into a CVS store. And so they have seen it already through Minute Clinic. But I think, those of us who've kind of been CVS customers, have walked into a store, have experienced the fact that they're still figuring it out. They're still figuring out how to make all the different pieces of the business work together to create a better experience for the consumer. I think the possibilities are incredible. You have a company that owns an insurance arm. You also have a company that now owns a clinical care delivery arm, as well as a retail pharmacy. And so if you can make the pieces work together, it'll be great. But as somebody who runs a nonprofit healthcare organization, I worry that some of these large entities will put profits before patients. And I think that is a real risk that we have to grapple with. I think the American public is tired of being seen as a profit center when it comes to their health and their wellness. And so I think that there is an opportunity actually for the nonprofit sector to step up and start to try to make some bigger moves. That's something that we're doing at Scan Group. We announced our intention to merge with Care Oregon, which is a nonprofit Medicaid-focused health plan in Oregon, and really try to make 1 + 1 = 3 to improve the experience for patients. Because I do think that the American consumer is tired of being seen as a profit center by U.S. healthcare.
Well, we've seen a lot of that, right? We've seen, for example, hospitals, they're also, many still non-for-profit, struggle to do so. And that's sort of where corporate comes in, where for-profit comes in. We saw during the pandemic, the government link up with these for-profit centers because of the scale, because of the ease of distributing services. So how can they compete in this space when you have the money and the network with these profit centers?
Well, I think it's through the integrated experience. At the end of the day, I think, these acquisitions cover one piece of the healthcare experience, primary care. But the minute that you need something outside of primary care, you may need a specialist, you may need a hospitalist, you may need a dialysis center. And so I think one of the potential risks of these acquisitions is actually further driving, what I would think of as the lack of connectivity to people's healthcare delivery, because a lot of healthcare delivery exists outside of primary care. And so again, I think the complexity of primary care services is one challenge for these large entities. But I think the complexity of connectivity to the broader healthcare ecosystem is something that the large healthcare systems have actually done decently well. If you have a major illness and you go to a large health system, your care can largely be contained to that large health system. You wouldn't be able to say the same thing about One Medical in its current form or Oak Street in its current form, even with all the assets that exist within Amazon and CVS. So I think that opportunity is for the nonprofit health systems to continue to drive towards a more integrated experience for complex patients.
Certainly something to watch. Okay, so pivoting really quickly to Humana and their push into Medicare Advantage. We know that Medicare Advantage at large, an area you operate in, has been criticized for waste and for, potential waste, and we've seen reports to that effect. What should we take away from this push into Medicare Advantage and away from commercial?
Look, we need companies that are focused on older adults. This is a specific segment of the population, and Medicare is focused. Medicare is the federal government program that is focused on people who are older adults and are disabled. I think that notion of focus is a very good focus. The thing I worry about, though, is Humana is a public for-profit company that has to deliver to shareholders. And I think as such, there are opportunities, I think, to focus more on shareholder return than on patients. And that's why I think, the American public writ large needs to grapple with this question of, do we want to be delegating the provision of medical care to for-profit corporations that are beholden to shareholders first and to patients second? I think that's a big question that we as a society have to grapple with. On the face of it, the move's a good move. Increasing focus on a single segment will hopefully improve service for people within that segment. But I do think that there is this bigger question of, what kinds of companies should be delivering these services, and I think we as a society need to grapple with that more seriously.
Certainly, especially as employers are also starting to question their third-party administrators. But we don't have time to get into that today. Dr. Sachin Jain, Scan Group CEO, thank you so much for joining us today.
Thank you, Anjali. Really appreciate the opportunity.
All right, thank you, Anjali, and thanks to Sachin Jain as well. Coming up, C3.ai stock rockets after upping its guidance. The company CEO says he's seeing a dramatic change in sentiment. Why? What does that look like? We'll ask him next.
Warren Buffett's annual shareholder letter set to be released on Saturday. The letter and what Buffett is buying, of course, is going to be closely watched by Wall Street, given the billionaire's prior investment success, a heck of a lot of it. Our own Josh Schaefer is here with a breakdown of how Buffett became a $100 billion man. How'd he do it?
So when you take a look at Bloomberg's index, it says that Warren Buffett is worth $106 billion today. Nearly all of that is tied to Berkshire Hathaway stock, which Buffett started buying at less than $10 a share in the early 1960s. Now today, one share of Berkshire Hathaway Class A shares costs about $463,000. But as Buffett's bets have grown bigger, some recent buys really stand out. Up first, Bank of America. Buffett famously piled $5 billion into the stock in 2011, and since then, shares have grown over 400%. Some thought Buffett was late to Apple when he started buying in 2016, but Apple shares have also risen more than 400% since he bought. And more recently, Buffett's been an oil man, dumping billions into Chevron and Occidental, with Chevron shares roughly doubling since Buffett significantly increased his position in late 2020, guys.
Okay, so where does Buffett stack up among the billionaires right now?
So he's not number one.
Okay.
We should start there, right? That's Bernard Arnault. He's number one, and then we've got Elon Musk at number two. And what I want to show you guys here, let's take a look at Elon Musk's net worth. See how that chart kind of moves up and down. It looks a little chaotic, right? Elon's still number two, but you can see it almost looks like Tesla's chart, right? To some extent, these billionaires, it's very tagged to what their stock does, right? And then when you look at Mark Zuckerberg's, he also shot up very quickly with Meta, but then see how much he fell as Meta's stock fell. Then when you look at Warren Buffett, the slow process, right? Buy and hold, buy and hold. A little bit more of a steady chart there, and significantly more than Zuckerberg. So that's sort of my biggest takeaway when you compare him to some of the other billionaires and maybe the modern tech billionaire, is Warren Buffett has been able to sustain, while some of these other billionaires are really pegged to one stock, one tech stock that has been a bit more volatile in recent years, while Buffett has been more consistent.
Slow and steady wins the race.
Yeah, indeed.
I always taught you that.
Yahoo Finance's own Josh Schaefer breaking down all things the Oracle of Omaha. Buffy the stock market slayer here on the day. Thanks so much, Josh.
C3.ai has been riding the huge buzz around artificial intelligence this year. The shares have gone up a lot, and they're still going up, spurred by ChatGPT and the buzz around that. But the company does have a longer history. It had its IPO back in 2020. It's headed by a software industry veteran, Tom Siebel. C3 reported its latest numbers after the bell yesterday, and Siebel struck an optimistic tone on the call. He's joining us right now. It's good to see you, Tom. Thanks for being here. First of all, for people who don't understand what C3.ai does and how it fits into this new and rapidly developing ecosystem, can you just set the stage for us, first of all, as to where you guys fit in?
Yes, C3.ai is a computer software company, and we spent over a decade and about $1.5 billion building a software stack that allows us to take enterprise applications like ERP, manufacturing, supply chain, CRM, AML, what have you, and make them use predictive analytics to make them predictive in nature, to tell us not what our inventory levels were, but what our inventory levels need to be, not what our customer churn was, but which customers are going to leave us. Not what our what the number of anti-money laundering events were, but we can stop AML in real time. So we're typically serving, say, Fortune 1000 accounts, Shell, Coke Industries, United States Air Force, what have you, with very large scale predictive analytics applications, applying AI to the enterprise to allow organizations to deliver products at lower cost with lower environmental impact into the hands of more satisfied customers.
Perhaps for our own edification and perhaps some of that of our viewers, what then is the difference then between the predictive analytics AI applications that are currently already available to your customers and some of the more new generative AI conversation that we've seen in the kind of language learning models that seem to be really coming into the fray?
Great question, Brad. So what we've done in the last 13 years, we've built 42 turnkey enterprise applications for oil and gas, utilities, aerospace, defense, manufacturing, banking, what have you, that we use to serve some of the largest customers in the world. Now, with the advent of generative AI, this represents a very interesting opportunity. We've been working with this since about 2020, and we have an architecture that allows us to take advantage of these innovations. And this generative AI, it's difficult to overestimate the impact of this. Now, we're not using it for chat. Okay, we're using it for a fundamental different purpose. We're combining enterprise search, think the Google user interface, with natural language processing, generative AI, and reinforcement learning to fundamentally change the nature of the human-computer interface. So for enterprise applications. So rather than look like these complex things with lots of menu structures and that kind of mind-numbingly complex supply chain applications, the user interface is just the Google search bar for HR, for manufacturing, for whatever it might be. And it's available on our website for anybody who wants to see it. There's a demo of the product. It's quite innovative. We've filed I think patents on the technology, I think 21 countries, but it's not, most people think about chat. This is not about chat.
Right, not about chat in this type of application. And yet, when you noted a dramatic change in business sentiment when you were talking around your earnings, does it have to do with the enthusiasm around ChatGPT and then the sparking of interest that has created? Or is it that the fundamental backdrop for the businesses you serve has been improving?
I think there's two things. Great question, Julie. I think there's two things that happen simultaneously. One, last summer in July and August, we just saw a significant downturn, in buying behavior in Fortune 1000 accounts. Everybody was hunkering down, preparing for a recession. They were scared. They were cutting costs. And, we called that pretty early. And since then, we've seen a massive tech recession with all the layoffs and what have you. And that affected us. Now, we're seeing in the market at large, something fundamentally has changed in terms of the people who are running these organizations are optimistic. They're moving forward. At the same time, there's been a realization that these organizations can use enterprise AI to fundamentally lower costs, serve customers better, deliver their ESG objectives, and deliver products with lower environmental impact into the hands of more satisfied customers. And this generative AI definitely accelerated the interest in AI. So AI now is at a peak, and that seems to work very well for C3 AI because I think we're the largest application player in that space.
When I was looking through the analyst commentary in reaction to your numbers, to your tone on the call, et cetera, one question I did see was that while you sound very optimistic, that's not necessarily showing up in your numbers as of yet. And I know you guys raised your forecast a bit for the full year, or I should say narrowed the range, but raised the lower end of it to some extent. When do you think you're really going to start to see an acceleration in the growth and in the numbers?
So I think in the coming year, we'll see a dramatic acceleration. Understand about 2 quarters ago, Julie, we changed our pricing model from a subscription-based pricing model where an initial contract might be 10, 20, 30, 40, $50 million, to a consumption-based pricing model where an initial contract is you just take the application, you install it, and you pay 55 cents per vCPU hour to operate it. So it's much easier to buy. Our pipeline of applications of opportunities increased dramatically. Now, the short-term effect of that puts downward pressure on revenue. The medium and long-term effect of that is something of a hockey stick in revenue, and we expect to see that kick in sometime in the next fiscal year.
Tom, you've been in the industry and executive at a tech company in one capacity or another, and especially given C3 AI's advancements, you've seen how this industry has changed. You've seen how management styles have changed as well, and it's almost being kind of hypersped into this next era when you've got CEOs like Mark Benioff, CEOs like Elon Musk even, who are far different than the tradition of what we've seen in the past. Do you believe that CEOs right now in the tech industry are looking at people like Elon Musk and saying that, that's something or a management style that we should be unleashing within ourselves?
I think Elon Musk serves as a role model, for a lot of CEOs. and he's enormously independent, enormously politically incorrect, and it's a little bit refreshing. So it's and very entertaining. He's obviously a very talented guy and a great genius, and he's accomplishing a lot.
Maybe some others couldn't tread that politically incorrect thing quite as, I don't know if I would say successfully, but without consequence, shall we say, as he has. Tom, finally, I want to zero in on the AI industry a little bit more too. Surely you're aware of what your stock has done this year, but also like anything else having anything to do with AI, right? Whether it's in the name, whether somebody drops the term in a press release, stocks have gone crazy. As Brad mentioned, you've been around for a while in this industry. You've seen other shakeouts, right? What do you think the AI shakeout, if you think there's going to be one, is going to look like?
Well, the analogs would be the Ethernet, okay, the internet, client server computing, the personal computing, the smartphone. AI is this is soon will be a $600 billion addressable software market. Excuse me. Everyone will be using enterprise AI applications, just like they use PCs, just like they use relational databases, just like they use CRM. When we started at Oracle, there was no market for relational database systems, and we established a market leadership position there. When we started Siebel Systems, there was no market for CRM. We created that market. Today, it's a $120 billion business. So we established and maintained market leadership positions in both of those markets. The game we're playing at C3 AI is see if we can establish and maintain a market leadership position in what will be globally, in what will be a $600 billion addressable market. Now, I think there's some probability we will attain that. Worst case is we might be in second place, in which case it's still a pretty good company.
C3 AI founder Tom Siebel, thanks so much for joining us here today. Really appreciate the time and the conversation. Look forward to checking back in the future too.
Thank you.
Definitely. Coming up, everyone, reports suggest that major Apple supplier Foxconn is looking to India for a new plant. Is this part of a big shift away from China? We're going to discuss that next.
Turning, well, we've been talking tech. Let's talk about Amazon. It's hitting pause on construction of its second headquarters near Washington as belt tightening continues. This all according to Bloomberg. Wow, Dan, remember, how long did we spend? During that Amazon competition? Where are we going to build? We want municipalities to court us. And then they finally awarded the golden ticket to Arlington, and now what's going on? This story is something.
Yeah, this was a huge to-do, as you said, Julie, when Amazon was talking about building its supposed HQ to companies, cities and towns, counties, states, anything you can name. They were just throwing themselves at Jeff Bezos's feet to basically say, look, come and build your next big headquarters with us. I live in Queens. Long Island City was one of the runner-ups, I guess, in the contest, and thankfully it didn't go here, and my rent stayed the same. But in Arlington, that's where they're supposedly building out this huge headquarters. It's supposed to have 25,000 people eventually, cost $2.5 billion, and now they're putting it on pause. And basically, it comes down to what Amazon is dealing with right now: the decline in overall spending on their e-commerce site. And this is just something. You also can't discount the fact that, look, people want to work from home. Why do you need a gigantic office complex with, an indoor forest is essentially what they're trying to do, similar to what they have in Seattle, when people don't want to be there. And so now they're putting pause on the second phase of this project. They already have the majority of the first side built out. They have a few thousand people there already. But, I think this just goes to show that, we're seeing more of this kind of movement when it comes to big tech and the kind of spaces that they are taking up in cities. I know, obviously Facebook doing some consolidation of its own. There were these grandiose plans for it to build out a larger presence. Same thing with Alphabet in New York City. They were going to build out their presence even further. But, you have to wonder if those kind of plans are going to all come to fruition the way they were originally planned, or they're going to kind of go to the wayside as we see, companies continue to grapple with issues, whether it's Amazon and the decline in e-commerce spending, or Google and Meta dealing with the decline in overall digital ad spending. That's likely to come back. But, people just don't want to be in the office if after, 2-3 years of successfully doing their jobs from home. So, it remains to be seen whether or not we'll see these big, huge projects moving forward.
Dan, I am sorry. I'm just triggered by this. My goodness. I mean, you had Bezos moving forward with a Bachelor-style contestant search for the new city that they wanted to move into. Cities were coming forward like he was the Prince of Zamunda. My goodness, Dan. And now it's just on pause? All right.
I mean, it's wild to me. And you're right. These cities did, they basically bent the knee to Jeff Bezos to get him to say, I guess, christen them with the new headquarters. And now the one that won is kind of dealing with an empty lot for a while, I guess.
All right. Meanwhile, Apple's core iPhone builder Foxconn making ever more serious moves to building in India, this time committing to a substantial investment. Dan, tell us more about that one.
Yeah, they're looking at a $700 million build out of a facility, and that could be used to build parts for their devices or devices themselves. And this is probably a larger part of Apple's plan, and not probably, but is a larger part of Apple's plan to get out of China, essentially. Look, they're not going to abandon China. They already have hundreds of thousands of workers there, or they contract hundreds of thousands of workers from Foxconn to build their devices. But they don't trust the fact that, there were issues with the plants during the COVID lockdowns, during the kind of draconian lockdowns we had seen for so long. And I think the political climate is also not as steady as it had been prior to the war in Ukraine and prior to, the I guess you could say butting of heads between the U.S. and China as far as the competition, as far as the two largest economies on Earth. And so, I think Apple is basically saying, look, we want to get out of the way of this. Let's try to get ahead. They're trying to build out in India. They already have plants in India, by the way, that are building the latest iPhones. They also want to move to Vietnam and other places in the region of Southeast Asia, rather, beyond obviously India not being in Southeast Asia. And I think, the bigger question here is, how long does it take for that to happen? And frankly, it'll probably take some years for, a significant number of iPhones or Apple devices to start being built there. But it is part of Tim Cook's larger plan. And look, he made his bones at Apple for developing their supply chain. And so you have to imagine if anyone's going to do it, it's going to be him.
Makes sense. We'll see how this continues to develop and if how quickly they can do it, how much it's going to help them, etc. Thanks for covering it all. I appreciate it. Yahoo Finance's Dan Howley. Coming up, charged up. As if that conversation didn't do it enough. Tesla's investor day was mostly a snooze, but the EV leader shares are anything but. Find out who is particularly hot on them next. Electric vehicle sales shot up by 65% in 2022, a dramatic increase for the rapidly growing industry. More EVs means more charging stations are needed, and our next guest company contracted, deployed, or sold more than 7,500 of them last quarter. Joining us now, Blink Charging CEO Michael Farkas. Michael, it's good to see you. It's been a minute, and obviously there's been a lot of developments in this industry. You guys reported your earnings earlier in the week where you talked about the growth in the charging stations. What is going to be necessary? I mean, we hear automakers like Tesla make big promises about how many cars they're going to be delivering. What's going to be necessary in terms of building out charging capacity?
We're doing it day by day, and it's going to be a big need as more and more EVs are on the road. As you mentioned, globally, we went from 6% on the prior year to 10% of all vehicles sold being EVs. That is a huge jump. Again, it's still a small percentage of global sales. But as you see what's going on, the growth is there. And legislatively, throughout the world, you're seeing making it illegal pretty much after 2035, 2040 to even build or buy non-polluting vehicles. So it's definitely in our favor. If you look at the industry now and where we see global deployments of charging stations, you're talking about 10, 12, 14 million chargers. Of those that are actually viable, I think the number is much less. And if you look at some of the estimates from some of the largest research shops, Bloomberg, McKinsey, and others, you're looking at 300, 400, 500 million charging stations that are necessary by 2040. So this is an industry that's going to be growing. With us or without us, it's growing. And hopefully we're going to be a big component of it. Okay,
and so what is the component of it that you are right now from what you're seeing in terms of your footprint?
We're one of the largest operators. We've now touched close to 70,000 chargers deployed through our history. That makes us one of the largest global players. We have a presence in 25 countries. And we're seeing that grow continuously. Every place where you're going to have cars, whether it's the highest earning countries or the lowest earning countries, they're going to have to ultimately migrate towards EV. That's what the manufacturers are going to be building. That's what the manufacturers are investing all their R&D dollars into, is EVs. Not really spending much money now on developing, spending on R&D for internal combustion engine cars. So that's where the industry is moving. Where we see ourselves is trying to position ourselves exactly where we've been, one of the first players in the areas that we enter. We're one of the largest players, first movers in the Latin and South American market, Middle Eastern markets, Mediterranean markets, Europe, across the board. And we're growing either through acquisitions, as we've done in the past, or through organic growth, and with organic growth.
And when do you sort of transition from a growth phase where you're building out all of these out of these stations into a profit-making phase? Because you guys are still losing money right now. So when does that sort of switch turn, so to speak?
Well, we're working on reducing our losses, increasing our revenues, and soon, hopefully, we're going to see them one overtake the other. But right now, this is an infrastructure play. You need to really look at this almost like a cell phone tower company or a cell phone company or a cable television system company in their early years. It's about investing, it's about growing the footprint, and while doing that, making sure it's done economically and methodically. And you can see from our history, that's exactly what we've done. For the first phase of our business, it was all land grab. Let's not think about the technology because it's going to change. Let's focus on just getting more and more clients, more and more acquisitions of locations where we have the rights to go ahead and deploy charging infrastructure. And that was our first phase. Second phase was then going out there, bringing in the right people to go ahead and develop the technology internally, because we knew none of our competitors were building the right piece of equipment at the right prices with the right functionality and features that really took the property owners and those that were investing in the infrastructure into consideration. If you look at all of the other manufacturers out there, they have a very simple model. None of these manufacturers own and operate. We're the only ones who do. We're the only fully vertically integrated EV charging infrastructure company where we design the hardware, we manufacture it. The network that the charging stations operate on is ours, and we own a substantial amount of the charging stations that we've deployed. And again, it gives us a different philosophy in developing hardware because our money is made on the sale of the energy, not necessarily the sale of the equipment. And our main focus and our model that we developed our business upon. Through certain acquisitions, we were able to go ahead and bring another complementary services, including the manufacturing and the network. And that allowed us really to build a piece of equipment that really is superior to our competitors. Look at the contracts that we've been winning. The United States Postal Service recently that we announced. You look at the dealerships groups that we deal with, General Motors, Audi, Subaru, and Mitsubishi, and all these others. These are companies, these are OEMs that manufacture vehicles. They're testing our charging stations and benchmarking them against every other charging station company out there. And we're winning these orders. And remember, this is not our main focus. Our main focus has always been owning and operating the chargers. But since we built such an amazing piece of equipment for ourselves, we've really been able to open up the market and sell it to others as well. And we see the hardware sales business right now is outpacing our own and operate business because there's a lot of people who want to buy charging stations. And again, we're in an amazing position because we actually have the potential customer at heart, okay? We don't walk into our customers and say, hey, this is what we have and this is what we're going to sell you. Right. We actually ask our property owner partners, how do you deploy your capital in your locations? Property owners are very, very, very different. They deploy capital very differently. If you're a charge point, a salesperson, and you walk into that door, and that property owner is like, that's a great idea, but I don't do any of these services internally. I don't want to buy equipment. Sure. I want a service provider. That's not what they do. On the other hand, EVgo, Electrify America, if you like their product or service line, right, and you want to invest in it and put that into your locations and sell those services on your own and make the money off the sale of the energy, that's not what they do. Their salespeople walk out the door. Michael, our salespeople ask the customer, the property owner, how do you deploy your capital at your location? And we have the right model and solution for them to deploy that.
Michael, I got to jump in because we're limited on time here, Mike. We only have a couple seconds left, but did want to get to something outside of the expansion of the business. You're also fighting suspected illegal trading activity up against and investigating naked shorts, which is the selling of short shares that don't actually exist. So this started in February that you started to investigate it. Have you seen anything come forward from it as of this point in time? And
I want to give you some data so you can understand.
Okay, we only have about 45 seconds.
No problem. 65% of the volume yesterday was short sales in our stock. The day before that, 56. The day before that, 66, 53, 61, 71%, 73%, 71%, 62%, 57%. This is the amount of the stock that's sold. All orders are tagged, whether they're held long or short. This is the percentage I just gave you of all sales sold during that day and what percentage of them are short sales. There's naked shorts that we've uncovered so far, 4 or 5 million shares. This is just the beginning. This is one of the most heavily shorted stocks on the exchanges, period. And we're making some tremendous headway. And I will tell you, everyone who has damaged this company for selling this stock illegally short will pay for it in a very big way.
Have you been able to trace that back to anybody?
Yes, we've traced it back to certain prime bankers, and I'll keep it at that for now.
All right. Michael Farkas, thanks so much for joining us here on The Day. Blink Charging CEO, we appreciate the time.
Thank you for having me. Be well.
Absolutely. Coming up, Portillo's CEO joins us to chat fourth quarter earnings. Stay tuned. Portillo's closes out its first full year as a publicly traded company with mixed fourth quarter results, all while navigating commodity inflation and higher labor expenses. Here to discuss Portillo's sales trends and path for growth, we've got the CEO, Michael Osanloo, who is joining us along with Yahoo Finance's Brooke DePalma. Great to have you here with us back again. Last time we spoke, we were enjoying some very good chocolate cake, which I'm still not sure that we've discovered the secret ingredient of, but we will leave that for another discussion. Walk us through the catalyst for this most recent quarter here and take us into where, going forward from here, you're kind of prioritizing some more growth there.
Yeah, well, first, thanks for having me. I will not tell you the secret of our cake, but the catalyst is that the catalyst for us is that we really do stick to keeping it simple, which is we try to provide amazing quality and value for our guests. We take good care of our frontline team members so they can satisfy our guests, and we create this virtuous cycle where great, happy guests, great, happy team members result in great, happy investors. So we keep it simple: great food at a great price.
Good morning, Michael. We've heard from so many executives this past quarter who have taken price increases. That includes Dine Brands CEO, and I just wanted to take a listen of what he had to say.
When you look at how our franchisees raised prices last year, they raised them 7% or so at Applebee's, 10% at IHOP. So we like what they did strategically in that they took about half the cost of inflation in terms of price.
Michael, break down for us what sort of price increases Portillo has taken to offset inflation, and are you seeing any consumer pushback there?
Yeah, so we've talked about this publicly. We believe in a price laggard strategy, which is we let everybody else price however they see fit. We price a little bit slowly. We price behind the curve. So we actually priced for most of the year below 8%. We were lagging all the inflation metrics. And we purposely invested in the consumer to make sure that the value proposition for a Portillo's meal was outstanding. That said, we still have to price. You have a financial responsibility to hit targets, et cetera. So, but we just price a little bit more slowly. And that's how we'll continue to do it. I think that this price laggard strategy for us has paid off. As I mentioned in our earnings call yesterday, we're positive traffic, positive sandwich count for 2023 so far. I think that says that consumers are voting with their feet, and that great value proposition in a recessionary-like climate really works well.
Are you seeing people trade down to less expensive menu items at all?
No, fortunately, we haven't seen a lot of that. We're seeing a little, just a tiny bit of mix change. So, you know, if people might not be attaching things quite as frequently, if they used to get a large fry, they might be getting a small fry. But that's a very, very minor dynamic for us. And as I think you all know, like our average ticket is $10 or less. So we're very affordable for the quality of what you're getting.
I know that when I get a chance, I definitely need to add on those cheese fries. I've been eyeing them for quite some time. Yeah. But earlier this year, Portillo's did face shortages in fries as well as onions. What sort of shortages are you seeing now, and where do those onion and fry supplies stand now?
God, I hope you didn't just jinx us, but right now things look fine. I think we have sufficient capacity of fries and onion rings. Now the cost has gone up significantly, as I'm sure you guys are aware. But right now, knock on wood, we've got plenty of fries and onion rings to satisfy our guests. In fact, I'm not seeing shortages anywhere else in the supply chain. The supply chain has, I think, caught up from a shortage standpoint. Some prices are inflated, some are coming down, but we discussed this. We expect to see mid-single-digit commodity inflation for 23.
You were mentioning some of the sandwiches just a moment ago, Michael. I'm wondering here, where customers are continuing to buy specific menu items in the sandwich category, what is perhaps the most recession-resilient sandwich that you've seen customers flock to?
I'll tell you, I think our top three things that we sell, Italian beef sandwiches are number one, hot dogs are number two, and French fries are number three. It's consistent across the board. And it's funny, you know, we just opened a restaurant on January 18th in the Colony outside Dallas, Texas. 70% of the sandwiches sold were Italian beef. I think people were surprised by that. People were wondering, is that sort of a very quirky menu item that only sells in Chicago? But the fine people of Texas seem to like beef and bread.
Huh. Imagine that obscure beef and bread combo, right? Michael, you talked a little bit about, on the call and in the statement, about commodity inflation still rising in the mid-single digits. You know there's this big disinflation theme, right? So what kind of color can you give us from along the whole cost input chain there as to where you're seeing more pressure, decreasing pressure, et cetera?
I think, look, inflation, we did not get to the inflationary levels in one quarter, one period. We're not going to deflate in one period and one quarter. So third quarter of 22, we saw 15% inflation. It was 14% inflation in the fourth quarter. It is tapering down. It's not going to be like a light switch goes off. It's more like a dimmer. And there's year over year numbers. We saw commodities go up at different periods last year. So you can imagine to get to mid-single digits, you're going to start relatively high at the beginning of the year, and you're going to slowly come down. And that's assuming that the underlying drivers of inflation don't change a whole lot, which, there's labor inflation drives a big chunk of the inflation pressure on the cost of sales. There's also labor shortages. So we kind of need those things to taper off or improve over the course of this year to get back to a more normal inflation number.
And labor is at the forefront, especially at that new Colony opening. People waited an hour and a half for one of your beef hot dogs and those beef steak sandwiches. Break down for us how exactly you hope to invest in labor to open more stores and what you learned quickly from that store opening.
So, and just to be, I'm not trying to be a nit-natter, but they might have waited an hour and a half to order. But when they ordered their food, they typically got their food in 6 to 8 minutes, and it was hot, fresh, and delicious. So that's the feedback we've gotten from our customers at the Colony. It's doing volumes that the restaurant is not meant to do. It's pushing, $17 million annualized number for sales. It's not gonna where it's gonna end up. It's gonna come back down. The restaurant simply is not designed to do that much in sales. So that's a little bit of what happens when we open up with as much buzz as we did. It's super exciting, it's fun, etc. But over time, we get to a much more steady routine, and the business performs. At the Colony, we've been blessed. We hired within 2 weeks 120 fantastic people. We hire based on values. I'm not hiring you because you spent 20 years in the restaurant industry. We hire you because you want to act like you're a family member. You believe in being great. You act with urgency. You want to have fun. And so we hire based on our values. And I think that lets us be true to who we are, but also appeal to people that care about a values-based organization.
Mm-hmm. And maybe also attract people in what is a very tough labor market too. Michael, great to catch up with you. Thank you for being here, as well as thanks to our Brooke De Palma Portillo CEO, Michael Alsanlu. Good to catch up with you. Have a great weekend.
Thank you very much.
Thanks. Let's take a quick look at the markets here. We're seeing some strength to end the week here. Actually, quite a bit more strength than we had seen earlier in the session, which is quite interesting. And it also looks like we're going to break the 3-week losing streak that stocks had been on with an increase this week, Brad.
Yeah, I'm keeping a close eye on Apple, as the rest of our viewers should as well, as we go on throughout the rest of the day. As we close out this 10 a.m. hour, Apple higher by about 2.5%. It's being reflected in some of those major averages as well.
Yeah, and communication services, consumer discretionary, and real estate are helping lead some of the gains that we're watching today. Coming up, Rochelle Akuvo has you covered up till the noon hour, so keep it right here on Yahoo Finance.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching. The bond market leads. Stocks push higher, but investors keep an eye on rising Treasury yields. Now, this after a big week, of course, for Fed speak. We'll break it all down and where the rates debate is going next. And Bitcoin falls $1,200 in just 30 minutes. That's the biggest move since the FTX collapse. Now, was it due to a big trade or more fear of contagion from crypto-focused bank Silvergate? We'll discuss coming up. And what just happened? The chips aren't down for Broadcom. It sees a soft landing on the horizon and investors like the sound of it. But who benefits the most as the US government doles out the cash? That's just ahead. But first, let's take a look on how the major indices are faring 90 minutes into the trading day. We see some accelerated buying as we're coming into this 11 o'clock hour. The Dow, they're up more than 120 points. The S&P, they're seeing gains. They're up about 30 points on the day. Tech-heavy Nasdaq pushing up the highest of the three, up almost 1% on the day, about 113 points, as we're digesting, of course, this volatility that we've been seeing with the Fed. Well, let's see how that's been affecting the Treasury market as well. Some people looking for some safe havens, perhaps. We see that the 5-year, though, down just slightly, about 0.6%. The 10-year down 1.6%, and the 30-year down about 2.5% on the day as well. All right, well, let's start with some breaking news. The Fed out with their monetary policy report. With us, Yahoo Finance's Jennifer Schonberger. Jennifer, what's the latest?
Rochelle, the Federal Reserve out with its monetary policy report to Congress ahead of Fed Chair Powell's testimony on this report to the Senate and the House next week. The report underscores that inflation, while down from the middle of what we saw levels last year, still remains too high, and that ongoing increases in interest rates are required to bring inflation back down to the Fed's 2% target. Now, this will likely require a period of below-trend growth and softening in the job market. The report also noted that market functioning remains orderly, but that market liquidity in several markets, notably the Treasury market, remains low when compared to pre-pandemic levels. The Fed said that it is prepared to adjust the unwinding of its balance sheet if needed, if there are changes in the economic and financial conditions. Now, the Fed also noted that financial conditions have tightened significantly since last June, but that valuations in the stock market remained notable and ticked up on net as stock prices increased modestly even as earnings expectations dropped. Now, Rochelle, separately this week, we received notable Fed speak. Atlanta Fed President Raphael Bostic said there is the case that could be made that the Fed will need to raise rates higher. He said consumer spending is strong and labor markets remain quite tight, and those suggest that the economy's strength could be a bit more than people think, which means we might need to do more. These comments suggest there may be room for upside to Bostic's belief that the Fed needs to raise the policy rate by 50 basis points to a range of 5 to 5.25%. He also said he favors holding rates at that level until well into 2024. Now, we also heard from voting member Minneapolis Fed President Neel Kashkari, who said that he's open-minded about whether to raise by 25 or 50 basis points at the next policy meeting. Kashkari says he'd lean towards continuing to raise rates further than the 5.4% he projected back in December. Now, next week, all eyes will be on Fed Chair Powell when he delivers his testimony to the Senate on Tuesday, followed by the House on Wednesday. Back to you.
And Jennifer, turning back, of course, to Raphael Bostic, I've noticed that he continues to make headlines despite not being a voting member this time. Can you explain why?
Well, President Bostic is going to be a voting member in 2024, and he is still part of the FOMC. And he is a voice that people listen to because he's in there, right? He's got his eyes on what he thinks monetary policy should be, and he's pretty direct in expressing his views. I think also the fact that he's been perhaps more a little middle of the road, and now, based on comments this week, becoming a bit more hawkish. That's caught a lot of people's attention that perhaps other members within the Fed are also leaning in that direction. And we've heard comments of that ilk from other members as well, suggesting that perhaps The median outlook for the peak level on the Fed funds rate of 5 to 5.25, which is Bostic's baseline, has some upside to it, as he himself had suggested.
Certainly, we've been hearing more focus on Bostic, as he does seem to be making some of these projections more correctly, or at least giving us a little bit more insight ahead of some of these FOMC decisions. Jennifer Schonberger, thank you so much.
Thanks.
All right, well, let's look at how markets are reacting as the Fed reiterates its call for rapid rate rises and a reduction of securities holdings. Joining us to discuss is Gitu Sharma, Alpha's Future founder and investment manager. Good to have you on the show, Geeta. So, of course, a lot of Fed speak to digest. And we've seen, in January, we had this rally. In February, a bit of a reality check. Where are we now in terms of the markets factoring in Fed speak and really being on the same page?
Hi, thank you for having me. I think we are really seeing the equity markets being disconnected with what the Fed is talking about and what we are seeing in the bond market. Effectively, the markets are undoing the decline we saw last year, even as interest rates have only gone up. And on so many measures that if you look at the metrics for equity valuation relative to bond valuation, we find that equities are really looking unattractive on a relative basis. If you look at 10-year yield giving us 4% versus a dividend yield of 2% plus, that's not very attractive. And even on our equity risk premium basis, we see that equity risk premium is about 1.4% right now, which is the lowest ever except for the dot-com bubble. And we clearly don't see the markets heading towards another bubble-like scenario. That's not where we want to be. So I think the market is probably pricing a soft landing scenario and assuming or believing that economy is going to slow down but not head into a recession, and the Fed is going to end its rate hiking cycle and probably go down pretty fast. Now, we have to see how the data plays out. We've had a kind of resurgence in inflation in January. Let's see what the February numbers look like. And then let's see what the Fed actually delivers in the next meeting. I think that will determine the trajectory of the equity markets for the near term.
Because they certainly have seen some whiplash going back and forth to start off the year. But what about long term? What are your views on some of these growth stocks?
I think so. There is something the growth stocks are definitely an attractive place to be if you think about especially the ones that are innovating and in the tech space. And we have a lot of mega trends like investing in energy transition or Internet of Things, electrification of everything. All of these are exciting investment opportunities, but they don't come without risk. And one of the ways we measure risk is what is the expected return on these stocks, even given the growth. Now, we are seeing a lot of these companies priced for very high growth rates over the next 4-5 years. And it's fair to assume that every company in the industry will not achieve that kind of growth rate. Somebody will falter and there'll be competitive activity. So if you price in all of that growth and you still don't see an upside, then then you're only buying into the risk and not getting the yield for that, and that does not make sense. If interest rates stay high, you definitely want a high yield. Otherwise, you can get a risk-free 4%, 5% in bonds. So I think growth stocks are at risk, but we are looking at more the quality growth stocks that have high return businesses. They can invest in growth, don't have to go into the markets to raise funds, and have the strength in the business model to sustain a difficult economic environment or competitive activity. We're also looking at some of the quality value names, which look attractive given the interest rates where they are, and again can sustain themselves in a more difficult macro environment.
And Gitu, when you look at where valuations are, we're at the tail end of earnings season here. We're seeing a lot of companies being a lot more strategic as they're keeping that eye on margins as well. What are your expectations? Obviously, still bracing for a lot of volatility as we don't know what's going to happen. What's looking attractive to you? Where do you see opportunities in this sort of environment?
So we have, I think, the earnings for S&P 500 index have come down, but many companies have reported strong earnings and are not as bearish on the outlook as maybe how we thought about it coming into this year. And so what it highlights is the strength of the economy that we are also seeing in the inflation data, the labor market, the the consumption patterns, retail sales. We're seeing the U.S. economy do well, and so the companies are able to pass on a lot of the cost inflation to their customers, get pricing power, and achieve higher revenue growth, maybe some margin decline, but generally higher dollar profits. And so I think as long as we continue to see this economic strength, we will, companies, especially the ones that have competitive advantages, they're going to continue to, report strong numbers. But given that the Fed is bent on tightening this economy and creating some kind of slack, I think the fact that earnings may be peaking and might head lower is definitely a chance. And then given that, if the valuations stay high and multiples stay high, then you're really not, there's that risk of sudden decline in the markets, which currently clearly we're not pricing in.
Indeed, especially as we look at the action that we're seeing today. Gitu Sharma, Alpha's Future founder and investment manager, thank you for your time this morning. All right, let's turn now to some recent tech earnings. Dell rising after strong earnings despite a moody outlook. The PC builder seeing full-year revenue moving down from 12% to 18%. And Broadcom also seeing an earnings beat, the chip maker reiterating strong spending in its cloud infrastructure. All right, coming up, China's big two sessions meeting kicks off this weekend. What are President Xi's priorities? Yahoo Finance's Rick Newman breaks it all down next. China's Two Sessions annual parliamentary meeting kicks off this weekend as delegates gather to tackle national priorities. Here to break down what to expect is Yahoo Finance's Rick Newman. So, Rick, what's on the agenda?
Hey, Rochelle. A lot of economic planning in China. President Xi Jinping will be nominated for a third term. That is no surprise. But I think analysts here will be looking for things coming out relating to the economic growth targets China sets. Remember, they try to manage their economy much more than we do here in the United States, and they will set a GDP growth target. That's important because all those COVID lockdowns in China last year really cut into economic growth in China, and that actually put downward pressure on global commodity prices all the way to oil and gasoline prices that we pay here in the United States. So when the Chinese economy is running hot, their demand for energy and other commodities is strong, and that pushes prices up here and all over the world. So that's one thing to watch for. China has actually been underperforming. I mean, they supposedly are bouncing out of the COVID slowdown there, but there's some data suggesting that that economy is not really bouncing back as much as we may have thought. And that is showing up in oil prices, which really have stayed fairly subdued. So I think that's what we're watching for, is signs about what may change with regard to China's economy for 2023.
We know a lot of companies obviously banking on that reopening plan. And then also with China, of course, the ongoing question of whether China will help Russia with weapons, of course. What can you tell us there?
Yeah, this is a big concern in Washington and European capitals. The State Department, the U.S. government, has been publicizing intelligence. It has suggesting that China may get more deeply involved in helping Russia with the war in Ukraine, perhaps even sending Russia weapons or other things that could help on the battlefields in Ukraine. That would be a real negative development from the perspective of Ukraine and its allies. So the United States has been warning, hey, China, don't do it. You don't want to get on the wrong side of this war. And so far, there's been no further indication that China may be helping Russia with weapons. So that doesn't mean that couldn't change in the future, but that is a really hot issue to watch because relations between the United States and China are already very tense. And if Russia got more involved in the Ukraine, China more involved in Ukraine, where that would make U.S.-China relations even more fraught.
Definitely a very delicate balancing act here that they're trying to make here. Rick Newman, thank you so much.
See ya.
All right, well, Tesla's China factory shipments tick higher in February from January. That's according to preliminary data from China's Passenger Car Association. Here with the details on Tesla's presence in China is Yahoo Finance's Pras Subramanian. Hey, Pras.
How you doing, Rochelle? So strong China sales here. Investors like to see that. Sales up 32% from a year ago to 74,400 units or thereabout. That's about a 13% jump from January. So, overall, not a surprise. The Chinese new energy market, meaning cars that are hybrids or EVs, supposed to be up 30% in February. So not surprising that Tesla is doing well here. But, remember in January, they cut prices for both Model 3 and Model Y. And that being said, their market share actually fell from 9 to 10% from a year ago. This, as competition from BYD, their big rival, their heats up. BYD seeing their share jump up 37% from 27% because they sell these cheaper hybrids and smaller EVs. But Tesla is more concentrated on the higher end luxury end of the market. So that's why you're seeing sales jump here, but not as much as a BYD, for example.
And of course, Tesla's always going to have its loyalists. So among individual investors, Tesla stock is still the talk of the town. What can you tell us there?
Yeah, and looking closer to home here, Rochelle, the journal citing data from Banda Research finds that retail investors spent $13.6 billion on Tesla stock up this year so far. That's approaching the $17 billion that they had spent all of last year. So really huge numbers here. Retail investors spending big on Tesla here. And we saw the stock, pump up about 55% this year. So that's part of that enthusiasm we're seeing. That's why the stock price moved up. Now, many bought ahead of Tesla's big investor day on Wednesday. Apparently, Banda says 500 million in Tesla shares were bought before the event. Stock then fell 6% after that as they're sort of of a muted enthusiasm for what they were disclosed there. But, Tesla fans seem to, they're not going to sell. There's a high conviction right there for these retail investors. They like holding on for the long term. Plus, the journal notes that there's also heavy interest in Tesla options market. Deep out of the money options are very popular here, those types of trades. So it seems like the lottery ticket type trades are in vogue, at least for Tesla investors at the moment.
That's interesting. Even despite not really getting what they wanted out of that investor day, still bullish in the long term, it seems. Franz Subramanian, thank you for that update. All right, coming up, Bitcoin falls $1,200 in just 30 minutes. That's the biggest move since the FTX collapse. Was it due to a big trade or more fear of contagion from crypto-focused bank Silvergate? We'll discuss next. Bitcoin fell nearly 5% Thursday night, its largest one-hour drop since FTX's collapse, and still, as you can see, under pressure today by more than 4% in the red. Yahoo Finance's David Hollerith has the details for us. Hey, David.
Hey, Rochelle. So the price, not just with Bitcoin, but across the crypto market, Ether as well, and the total market capitalization for all crypto assets, had a plummet within the hours of 8 and 9 p.m. New York time last night. And it was a very sharp, direct, short plunge, meaning that, it looked pretty much like something was happening. A lot of people were all reacting to the same thing. And since then, there's been a lot of concern as to, what the market faces today. That being said, since the price had that one plunge, it's relatively stabilized at levels, Bitcoin trading at the $22,300 level right now. We saw a massive liquidations of Bitcoin long positions in that time too. So over all of Thursday, yesterday, we saw more than $200 million in Bitcoin long positions liquidated. And that is what causes a lot of these really sharp moves in a short period of time. But that being said, we haven't seen anything like this since FTX. So it's, of course, worth keeping notice on to see how investors respond and whether or not they see it as a time to yank more capital from the market.
And David, we did see Coinbase and others tweeting, talking about their association with Silvergate and saying how protected some of their customers were. What should we be looking at in terms of the fallout from Silvergate, say, versus the fallout from FTX?
Yeah, and Silvergate is kind of it's the event right now that it's a crypto specific event that everyone's paying attention to as maybe cause for this sell-off. And it's not really clear at this point, even though there is that happening, that Silvergate is at all directly responsible for this in terms of what's happening at the company. That being said, there's obviously going to be concern. And crypto firms have, over the course of Thursday, rapidly distanced themselves from Silvergate, warning anyone who has money at that bank that they keep it there at their own risk. That came from crypto exchange Bitstamp. So clearly there's a lot of uncertainty surrounding that. But Silvergate, although it is a crucial provider of US dollar to cryptocurrency conversions for accounts and businesses especially, it's not directly connected with retail, so this would affect businesses. And most of the businesses we spoke with said they had no material impact or connection to Silvergate. That being said, stablecoin issuer Circle did say that it does need to unwind some of its services with Silvergate. So we're still watching that, but it's a fairly isolated incident. And to this point, I think it's more the impact would be what would happen, what regulators would see as needing to happen in response to something like this. This is an exact example. If Silvergate is to hit a worst case scenario of what a lot of regulators have been cautioning and fearing for months in terms of crypto connecting with the traditional financial system. Excuse me.
Indeed, a lot of banking partners probably, have their antennas up as they look at this, and of course, crypto already under scrutiny from U.S. regulators. Yahoo Finance's David Holloway, thank you so much for that update. All right, coming up, a strong showing from Hewlett-Packard Enterprises in first quarter earnings. CEO Antonio Neri joins us next.
Warren Buffett's annual shareholder letter is out. Here are 3 top takeaways from the Yahoo Finance team. First up, a call to action to all humans: start saving money. Buffett says this: "It is those dedicated savers that are forefront in my mind as I write this letter." He adds, "Charlie and I are not stock pickers, we are business pickers, telling people to save money." And maybe they're listening. The U.S. savings rate is now at a 1-year high at about 4.7%. I think Buffett wants to see it even higher. Takeaway number 2, investing school is in no session. Again, no surprise here in the Warren Buffett annual shareholder letter. Buffett noting this, saying, quote, "The lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders." And yes, it helps to start early and live into your 90s as well. Warren Buffett, 92 years old. His longtime partner, Charlie Munger, 99 years old. Warren Buffett saying, if you want to be a successful investor, invest for the long term. No surprise, that's typical Warren Buffett being Warren Buffett. Takeaway number 3 here, a message or messages to all politicians here. Warren Buffett taking some jabs at folks in DC, noting this: Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Interesting take there from Buffett. Buffett also says, really tries to, I think, champion stock repurchases, saying repurchases, those that tell people that repurchases are harmful to shareholders or to the country are particularly beneficial to CEOs. You're listening to either an economic illiterate or a silver-tongued demagogue. So Warren Buffett taking some swings at politicians. What we did not hear in this letter, no succession plan. Warren Buffett and Charlie Munger will be at that May 5th to May 6th annual shareholder meeting in Omaha. Brian Sazzi out. A pretty good looking guy on their Warren Buffett promo. Let's say on all things tech here, Hewlett-Packard Enterprise is out with better than expected earnings for the most recent quarter. Let's get right to HPE CEO Antonio Nerio. Antonio, always nice to see you, my friend here. As you know, I'm an avid student of earnings calls. Good earnings call for HPE. I noticed a slight change in tone. You said demand was uneven. What do you mean by that?
Well, good morning, Brian. Thanks for having me again. Yes, demand is uneven now, although it's more specifically accentuated in the compute space, because as we said yesterday, in the intelligent edge, in HPC and AI, and in the storage business has been solid and constant. However, on the compute side, obviously we see elongated sales cycles and digestion of what customers bought last year. But all in all, we feel pretty good about our performance, which was record-setting in Q1, and the guidance we gave, which is based on our winning strategy, a 2x order book when we exit Q1, and the fact that we have amazing innovation that we continue to sell to our customers to meet them where they need it.
When you look at the growth rates in your business, Antonio, from around the world, are you seeing any differences? Is the U.S. outperforming? Is Europe outperforming? How do you see it?
It's quite interesting. Actually, it's fairly level, I will say, Brian. I think, I was in Europe last week. I did a tour in the northern region. And the partners and customers I met, they all said very clearly that IT continues to be a top priority for their spend. I was actually fairly surprised about that. But they all realize that now, with the data explosion that we see, the need to deploy AI everywhere, the need to modernize and deploy that cloud experience everywhere across the hybrid IT estate is actually continuing to be a top priority. Now, within that spend, they continue to make shifts. And one of the areas where they spend quite a bit of time is driving resiliency, because obviously it's a key component of what we see today in this uneven macroeconomic environment.
We earlier on on our network, Antonio, we were speaking to a tech veteran, Tom Siebel, over at C3AI, and he's dropping all sorts of he seemed very excited about the AI in his business. Now, you talked a lot about AI in your business. Is this just all hype? Is this a real thing here?
Well, actually, I concur with Tom. Tom and I actually were having a dinner together when we were in Davos. And I believe he's right. AI has the potential to disrupt every industry, and we are excited as him. Now, for us, it's quite interesting because for a generational change, as we think about these type of technologies like web, mobile, and others, this inflection point actually comes to our space because we have unique innovation. We have the best innovation when it comes to AI at scale, supercomputing power. And when we think about the generative type of language models we're talking about these days, they all need supercompute capacity. And HPE is the market leader when it comes down to supercomputing capacity and doing it in a sustainable way. One of the reasons why I went to Europe is because I wanted to talk to customers about their view of AI and then how they want to consume it. And we have an amazing pipeline that actually allows us to think about offering a cloud supercomputing that they can consume as a service. So very exciting for us, and there is opportunity to partner along the way.
Thanks for that invite to that dinner, Antonio. I was in Davos. I saw you there. I wouldn't mind catching some food with you guys and hearing about AI. But dig deeper here for us, because a lot of investors I have a lot of AI conversations coming at them. They're confused. So when you say you power, or your offerings will power some of this AI, what do you mean by that? And what do you see in terms of order trends as you look forward because of it?
Well, I think, we need to differentiate the AI models, right? So AI is a broad term, right? So we think about machine learning operations as an example of that. To me, that's more inference and ability to process data at the edge. Then, when I think about AI at scale with large simulation and models, like, finding cures for diseases, designing the next, turbo engine and the like, and even applications like chatbot GPT, you need models that are very, very accurate, that constantly train and retrain themselves. But one aspect you have to address is the ability to prepare that data, to automate data pipelines, so developers can run those models at massive scale. And we as a company have a unique set of innovation that allows us to run this model at massive scale. Let me give you an example. With the Frontier system we deploy at the National Laboratory at the Oak Ridge Lab, we actually can run quintillion transactions per second. And you think about what that can do to models like ChatGPT, that can change the game. But also the fact that you're doing with 35% less energy. So we have to think about this in very radical ways. And HPE has unique innovation in the interconnect fabric and the ability to chain massive amount of computational power. In fact, the Frontier system is like 40,000 GPUs. So we believe we are very well positioned, but our goal is to offer an infrastructure as a service for supercomputing. So it's a supercomputer that runs on the cloud, and a PaaS layer, a platform as a service layer, to eliminate those very tedious type of work, including the data pipeline automation.
Antonio, all that sounds like a huge opportunity for you and your company. I look at the valuation on the stock, about 7.5 times forward earnings, 2 times order book. What's the street missing here, and why do you think they don't necessarily value you at the same level as some of these AI plays?
Yeah, I said many times, and I said at Davos, we continue to be, undervalued by the composition of our portfolio and the progress we have made. Listen, in Q1, we established a record-setting performance. It was the highest revenue since 2016. We delivered the best ever operating profit at 11.8%, and we achieved the highest ever EPS of 63 cents, which obviously was well above our guidance that we provided a quarter ago. Combine that with our winning strategy across edge to cloud, and the fact that we have amazing innovation, both organic and inorganically, right? We acquired 4 companies. We actually have the confidence to continue to win and raise the outlook for the revenue and the EPS. In fact, the new revenue outlook we provide is 2x the original outlook. I think the street sometimes get fixated on compute, honestly. Compute today is now actually coming down as a percentage of the total revenue. It's only 44% from the high 50s. And you need to look at the intelligent edge. The intelligent edge business, we talk about that as being the rule of 40, 20% growth, 20% profit. We deliver 31% year-over-year growth with more than 20% profit. AI again grew 37% this quarter, and storage was very solid with 10%. And we continue to manage that compute business with best-in-class profitability. In fact, we delivered 17.6% operating profit, which is even higher than some of our competitors have with a combined total enterprise business. So I think people need to digest that a little bit in the last 2 days with a lot of news. But I believe we are positioned for success. And remember HP GreenLake. It is a platform. It's the cloud platform. We deliver all these experiences. And that business today, in less than 2 years, we doubled the total contract value now up to $10 billion. And that revenue will unwind over the next 3 to 5 years.
I encourage everyone that has seen this to go read your annual report, because I think a lot of investors are in fact missing some of those growth stories in your business. HPE CEO Antonio Neri, always good to see you. Have a great weekend.
Thank you, Brian.
Coming up, what just happened? The chips aren't down for Broadcom. It sees a soft landing on the horizon, and investors like it. But who benefits most as the U.S. government doles out that cash? That's next.
This week marked a major step forward in the government's push to bring more semiconductor manufacturing capabilities to the U.S. Ines Ferrer is here to tell us what the Chips Are for America program means for the industry with this week's installment of What Just Happened. Hey, Ines.
Hey, Rochelle. Yeah, and this program, this initiative is really described as a national security initiative for the U.S., to be making chips, semiconductors here in the U.S., not so much abroad. And up until now, it's been that the chips are designed in the U.S., but they're made in countries like China. So basically what this is an initiative that also highlights a concern that the U.S. has that semiconductors are made abroad and the dependence on foreign countries for semiconductors. So the rules were released this week for this plan, which is valued at about $50 billion, a massive investment in this industry. And this is through direct funding, through federal loans. A large portion of this money, about $39 billion, will be going towards the construction of new manufacturing facilities. Secretary of Commerce Gina Raimondo spoke with Julie Hyman earlier this week, talking about the requirements for companies to apply for this money. Take a listen.
We're stewards of taxpayer money. We have to have lots of information, transparency, accountability. We need financial information for each project from every company. We need to see a workforce plan for each project from each company. It's pretty extensive.
Now, of course, the critics of this plan are saying, look, you are giving money to an industry that is already profitable. Executives within the industry, though, say that there is little incentive to invest in manufacturing here in the U.S. because to take care of those factories, to build those factories is more expensive to do here in the U.S. The labor costs are more expensive. So this is certainly an initiative for them.
So talk more about some of these strings that are attached in order for companies to receive this money.
Yeah, so there are some significant strings attached here, and I'll just mention a few of them. One of them is that they have to agree to limit any expansion in China for a decade. So this is a very important part of this program. Another one is that applicants will be considered on their commitments to refrain from stock buyback programs. So of course, if they are receiving money from the government to put a plant here in the U.S., the government doesn't want them to turn around and buy shares back of their own company. And also another one that's very important is affordable childcare, and that would be affordable childcare in the areas where these factories are being set up. So that would be for the construction workers of the factories and also the employees of these manufacturing facilities as well, Rochelle.
All right, thank you so much. Ines Ferre there reporting for us. Well, semiconductor players, big and small, are scrambling for a piece of that federal CHIPS Act funding that just opened up this week. But who will be the big winners and losers when it comes to chip making? Here to talk all things chips is Bernstein Research Managing Director Stacey Rasgon. Thank you for joining me this morning, Stacey. So let's first talk about some of the Of course. Now, let's talk about some of these winners and losers here, especially when you factor in some of these strings attached, especially for those receiving at least $150 million of funding.
Yeah, no, you bet. So there are some strings attached, and they mentioned a few. The buyback one is kind of interesting. It doesn't say you can't buy back stock, but it kind of says we would really prefer it if you wouldn't buy back stock if you're getting funding. And that does have implications. I'll give you one example. Texas Instruments, for example, is building an absolute ton of capacity here in the U.S. Texas Instruments also buys back a lot of stock. Their general capital allocation strategy is to return 100% of their free cash flow net of debt repayment through dividends and buybacks. And so you could ask yourself, if TI, can't buy back stock to get this money, will they take the money? I don't know. TI doesn't actually need it. They're going to do what they're going to do regardless. On the other hand, you have a company like Intel, who is going to be one of the large beneficiaries of this. And in fact, you could argue that the CHIPS Act itself was sort of created, in some sense to help them give a bolster to U.S. leading edge semiconductor manufacturing. Intel stopped buying back stock, 5 or 6 quarters ago, and they just cut their dividend. They don't have the cash flow to do it anyway, so I guess it won't be a problem for them. They will be taking some of this money. But given some of the strings that are on this, some semiconductor companies are going to have to think, how important is it to get this funding? Do we need it or not? And, what are the trade-offs that we're going to have to make? It's not exactly cut and dry.
And as we look at some of these issues surrounding this, obviously we're seeing this act mostly focuses on production. The US already has, design covered. But what about the rest of the supply chain? You have the assembly, packaging, the testing market for semiconductors, also very important, still dominated by China and Taiwan. How far do you think this funding is really going to be in making the US more competitive when you factor in the other parts of the supply chain as well?
Well, let's step back. You could ask yourself, is this going to make the U.S. more competitive just in general? I'm not convinced that it will. You have to remember, the amounts that we're talking about here, they seem very large, but they're in fact a rounding error in terms of the amount of money that is really required. If the goal of this CHIPS Act is to really structurally increase the percentage of capacity that's installed in the U.S. versus worldwide, my guess is that percentage is not going to change very much with these kinds of numbers. The goal with these is to offset some of the cost differentials and actually get the stuff started here in the U.S. I think on the hope that over time you'll build more around it. So just a level set there. In terms of some of the other areas of the supply chain, you're right, packaging and everything, which is actually also, I believe, included and covered under this as well. Intel, I'll just go back to them. They're actually building a fairly sizable advanced packaging plant. I believe it's in New Mexico. And it's going to be $3 billion, I think, we're going to spend on that. And presumably that is something where they'll be able to apply for funding as well. The bulk of this probably will, I think, go toward wafer manufacturing, but there are other parts of the supply chain that this can apply to as well.
So let's talk about some of these specific chip makers. I mean, you mentioned Intel. Been struggling year to date versus, say, NVIDIA, which has pretty much been just off to the races. So as you look at what's happening within the semis right now, and as you mentioned, Intel is supposed to be the biggest beneficiary of this CHIPS Act. Why do you think we're still seeing a disconnect? How much of that is an Intel issue versus sort of waiting for some of these benefits of the CHIPS Act to kick in?
It's because Intel's business is horrendous right now. Like their revenues have collapsed. Their margins have collapsed. They've got a 3 in front of their gross margins. The last time that happened, I was in elementary school. It was in the 80s. They're burning absolute tons of cash. They're firing people. They're scrambling to cut costs. And in the meantime, they're still losing share in their key markets. And so there's a lot of the Intel issues that are Intel specific. They just cut their dividend. Again, they don't have the cash flow to support it anymore. NVIDIA, in contrast, I mean, to be fair, they already had to cut their numbers pretty sizably last year as the cryptocurrency market kind of imploded. That impacted some of their businesses. The thing about NVIDIA is their primary businesses are probably at a bottom now. We're in front of 2 product cycles, one in gaming as well as one in data center. They've kind of suggested, especially on the data center side, that it's going to be accelerating through the year. And they're on top of that, now there's just a ton of interest in things like generative AI, and I'm sure lots of your viewers here have played with ChatGPT and all this stuff. That goes right to benefiting them. And these opportunities, if you sit down and think about how big they could be over the long term, for a company like NVIDIA, they are very, very sizable potentially, and that's why they're getting the multiple and the stock performance that they are, as opposed to an Intel, which is structurally and secularly challenged and has had pretty sizable execution issues over the last couple of years.
And of course, we have to talk generative AI. You mentioned it there. And you highlight one of the companies that's really not getting as much shine as the others, which is Broadcom. Yeah. Why do you think people aren't focusing on them?
Well, I mean, when you think about like the AI winners and losers, if we want to go there, Broadcom doesn't necessarily come to top line. People think about compute and everything. The thing is, though, there's a lot of compute in these generative AI applications, and you have to put a lot of these things together. It requires a lot of networking. And Broadcom is benefiting on that front. They do networking chips. The other thing that Broadcom does that maybe like some people may not be aware is, there's lots of these like hyperscalers that are starting to build their own AI chips. Broadcom has a chip design business. They actually are doing the design work for most of those projects as well. And so they called out a fair amount. I think if you added up, it was something like $1.6 billion in incremental growth across their switching, their networking chips, as well as these chip design services year over year into fiscal 23, it came recently just from the generative AI opportunities, which is a really sizable. I mean, it would by itself, that would drive their networking business up probably high teens, 18, 19% year over year, even if the rest of it didn't grow. So they are actually a pretty significant potential beneficiary, not from the compute side necessarily, although some on the chip design, but also on the networking side. Not as much like top of mind for folks, and yet Broadcom is very, very cheap. And we did a note this morning. They reported earnings last night, and the title of the note was sort of like an AI story at a smartphone price, and that's kind of what you're getting right now. So I'm actually really liking that Broadcom story.
Well, certainly opportunities to be found there. As you see there, Broadcom flying under the radar, but maybe it shouldn't be. Stacey, thank you so much for joining me this morning, and have a great weekend. All right, coming up, we take a final look at the markets ahead of the noon hour. Stick around. Meta announced this morning the company's VR headsets are getting a big price cut in an effort to make the product more affordable. Now, since the headset's reveal in October, interest has been lukewarm, likely due to its high cost. Now, both the Quest 2 and the higher-end Quest Pro headset will see a price cut. Interesting that they're now obviously focusing on their VR and more AI. Just recently in a February 27th post, Zuckerberg saying we're creating a new top-level group at Meta focused on generative AI to turbocharge our work in this area. Makes you wonder what it means for the metaverse products. Right, well, as we close out this week, investors are already gearing up for next week with a lot of Fed and corporate action on tap. We have Fed Chair Jerome Powell submitting the Fed's monetary policy report to Congress on Tuesday. And on Thursday, Norfolk Southern CEO Alan Shaw will testify before the Senate about the train derailment in Ohio. And of course, Yahoo Finance will be covering the latest. Before we go, let's do a final check of the markets. We're seeing the Dow at the session highs of the day, but the S&P and the Nasdaq also seeing strong gains. The Dow, they're up more than 200 points. The S&P 500, they're up about 40 points, up 1% on the day. And of course, a lot of that push coming from the tech stocks. In the Nasdaq, they're up about 1.3%. They're up 146 points. Well, that'll do it for now. I'm Rochelle Akufo. I will see you Monday at 11 a.m. Eastern. Have a great weekend.